What's up, y'all? How we doing? It is Steve. I'm here with Trade the Pool. We're going to be going into some really cool stuff today. We're talking advanced gamma trading part 3. Just checking my levels here. What's up, Tyler? Go Bills. Let's go, baby. Love it. All right, all right, all right. Joe, if you could just give me a quick one in the chat to make sure my audio is good, and we will be well on our way here. Or you can just say it, I guess. Spicy week. Not too many trades for me, to be honest. Just been sitting in the pocket, waiting for conviction plays to come back to support, and taking conviction plays and shares as they materialize. Awesome, Joe. Glad to hear. So then we're ready to go here. Couldn't find your screen. I can't find my screen half the time. I got my comments on the left side, so I'm looking over here. Got the presentation over here. Got more stuff over here. Okay, I think we're just about ready. Now we're ready. Okay, guys, let's get on into it. People still filtering in. That's all right. Okay, we are going to just start with a little bit of an overview of what gamma is, gamma exposure profiles, and why we care about them. So we'll keep it pretty simple here. Just waiting for some more people to filter in. So if this is all basic new stuff or basic stuff to you, don't worry. We're going to be getting into a lot of really cool new stuff going forward here. But I just want to lay the foundation as people come on in. So gamma trading, what is it? So gamma is essentially going to be tracking the dealer exposure to options. So when we're talking about a big gamma level, that is a level where a lot of speculators, institutional, traders, they're going to be buying the call. For example, the 695 strike, let's say. And then that means that the market makers, they're on the other side of that trade. So they're going to be selling those 695 calls. And based on that action, we can infer a lot of really interesting things about price action. Intraday, if we see a lot of this zero DTE call flow come in, we will actively see market makers hedge against this. And this provides very reliable flows. So we talked about this we laid a good foundation in the first two parts, so be sure to go back and check those if this is a little bit over your head. But don't worry, if not, you're going to have a lot of stuff to build on here. And if it is over your head, like I said, we got the good foundation here, so absorb what you can here. I'll be trying to break it down in very relatively basic language so anybody can follow. But if you're missing one or two concepts, be sure to ask in the chat. But also, like I said, we got a good catalog to work through as well. Okay, Tyler, starting to add some CG and VST. Going to work in ETN for some long-term energy. Absolutely. The energy trade's really popping off. So for us, we have BE, Bloom Energy. That one's popping. We love that. FLNC in tiny size. That one's really ripping. And what else do we got? Talon had a good day. TLN. I've got a little basket going because it's hard for me to really pick any one when so many look good. Hey, back for your third week in a row. I really appreciate that. Ross Niggas Bloomfield. Yeah, okay, absolutely, brother. Come on in. You are more than welcome. Yeah, we've got a really good community that's just starting to grow here. So glad you're a part of it. Be sure to join the Discord community as well. And okay, I think I've talked enough. Let's get on into the fun stuff, guys. Let's get into the presentation here. So what we're going to be talking about today, we're going to be building on those gamma exposure profiles, and we're really going to be talking about how to make them actionable in your trading day. So we're going to be talking about regime changes, which essentially just means what happens when price changes from, in the course of a day, when we go from, for example, a negative gamma regime to a positive gamma regime, or vice versa, how we can trade those, and essentially what the implications are for the market structure on a higher time frame. So we're going to be talking about those multi-time frame analyses. We're going to be really going into depth on that because it really helps you get kind of a 3D perspective of where the market may be heading. So let's jump on in, get started here. Like I said, intraday regime changes are going to be very useful for you to be able to recognize. This is often the kind of setup that kills traders intraday because they can't pivot their bias fast enough along with the new incoming data. So being able to see that, in real time as it's coming in and, be able to pivot, that's going to really help on these days where I find a lot of traders, they do well in trend days, But when there is a change of trend, they can get chopped up really badly. So this can help you recognize those before you get chopped up. And then I kind of categorized potential scenarios in this multi-time frame analysis into 4 categories. So we're going to go through each of those and describe, basically what each one is about and how you can trade them, how you need to trade them differently to excel and to use this data for all that you can. Okay. Welcome, Cami Studio. Uh, Asking what platform do you recommend for options trading? So unfortunately, Trade the Pool. I work for Trade the Pool, so I can't suggest them just because they don't have it. But there are a lot of options. I personally, I use Webull for like my fun kind of gambly options trades. Zero commissions there, and they allow bracket orders, which is very important for me. So I need to be able to put an order in and have a stop and a take profit in instantly. I can't be on Robinhood and have one or the other. Maybe they've changed that in the past year or so, but that's why I went with Webull. For the big account, I like Fidelity. That's what I use, and then I also have a Roth account in Schwab. Yeah, Schwab slash what do they used to be? I forget. I trade it with Thinkorswim as the platform, and they're good. A little higher commissions. That's what I'd recommend there. But welcome on in. And yeah, Tyler mentioning having split portfolios, and I think that's a really good idea just in general, because you want to have a different portfolio for each trading strategy too. You don't really want to have your risky options trade in the same bucket of money that you have your long-term holdings in, because you're gonna want to use some of that money you've earmarked for safe plays for the more risky stuff. It's gonna just bleed into each other. It's so much easier to have like, okay, this is my risky account, whatever happens. If it does well, I transfer that money into the longer term account. Those go to shares of companies I believe in, stuff like that. All right, let's not get too sidetracked here though, guys. Yeah, TD Ameritrade. Thank you, Joe. That's the one that turned into Schwab. Yeah, when they bought them out. But luckily, I can still use my Thinkorswim because I've grown accustomed to it over the years. Maybe old fashioned, but hey, so am I. All right, getting back into the lesson here, guys. What do we got in store? So intraday regime changes. What do they look like? What are they? What causes a gamma level to flip intraday? So remember these gamma flip levels. That's what's called as zero, or referred to as zero gamma. So zero gamma means that the delta for market maker positioning on whatever time frame we're looking at is neutral, is flat. Essentially, this is the area where it flips. And that's really important because, as we talked about in the earlier webinars, when you're in a negative gamma regime trading under that zero gamma level on whatever time frame, you are going to see very different characteristics in price action. So all of our favorite buy the dip price action, that's going to be in positive gamma regimes. When you get into these negative gamma regimes, you can get really aggressive moves in both directions. So that means maybe we're in a downtrend overall. Usually we are if we're in negative gamma. So price is seeking a lower target, but in that process, it can make really jagged moves to the upside as well. And that essentially is going to be these people positioned short getting squeezed out short term, because when you're in negative gamma, all of the moves are amplified in both directions. Super important to remember this. So if you have your stop really tight, you're expecting a higher low, for example, in a negative gamma regime, you're much more likely to get that stop triggered. It will do an expanding pattern where it goes out of both sides of the pattern, takes those stops, and then continues on in its chosen direction. So this is very different from positive gamma, where you're just in drift up mode. So in negative gamma, the market makers, they have to pour gasoline onto the fire. They have to sell into big sells. They have to buy into big buys. In positive gamma, they're acting in the opposite kind of paradigm? I don't know, the opposite modality, where they are providing a volatility dampening effect on the market. So if people are buying really hard in a positive gamma environment, well, dealers have to sell into that. So it's going to curb the aggressive upward action. But on the flip side, when that aggressive upward action eventually subsides, the pullback, the dip, will be much less intense, much less volatile than it would be in a negative gamma regime, because the selling that institutions are doing in a positive gamma regime is getting absorbed and bought up dampened by the market makers. So that's I know you're probably sick of me saying this over and over, but it's a really important concept to know. So if any one person who's in here didn't understand that yet, definitely worth the time. So we've understood what is positive gamma, what is negative gamma. So let's talk about what actually causes these flips. So a basically large institutional options flow is going to lead to the dealer positioning changing, and that can cause the flip very fast. So if we are trading at this, say we're trading right under zero gamma, or the zero gamma level, and then just a ton of puts come in. A ton of puts come in. The market maker has to essentially hedge against those, and that can lead to a very fast loss of that level and just the bottom kind of falling out. As okay, now the dealers are in negative gamma, and we just they got to add fuel to the fire, so it can cause a breakdown pretty severely. So that would look like the breakdown. And when you break down and you hold under zero gamma, if price can close multiple candles under that zero gamma, then this new regime can start to establish. And then instead of trying to play like this mean reversion range bound, price action, you should be switching your bias to say, okay, hey, this setup's off the table. We're probably not mean reverting. We should be looking for a volatility expanding trend day down type setup, or at least a big push down. So on to point 3 here, when zero DTE options expire, that also is going to change these intraday gamma exposure profiles, and it's going to allow for situations where they can be kind of pushed from negative to positive or positive to negative. So as the morning options expire, new gamma exposure levels, they're going to take over. And so that's why it's really important to have multiple time frames. You can't be too honed in on just the zero DTE gamma. It's very important, especially if you're a zero DTE trader, but it's really important to see how that is going to kind of nestle into the context of the weekly gamma exposure profile, of the monthly gamma exposure profile. Just like when we're looking at a chart, sure, the intraday price action, it matters because any big change, it has to start somewhere, right? It has to start on a minute candle. But the seed for that minute candle setup to break out and push up, that has been established on the hourly chart, on the daily chart, on the weekly chart. So it's all what's that? Kamala Harris quote, like, we all exist within the context of the world around us. It might sound silly, but it is very true. If we don't think about the context in which our current situation resides, then we are basically flying blind. So the last thing here is just major news or catalysts. This can change things very fast. If you have a day that has a binary outcome, for example, market is expecting, I don't know, a cool CPI, and then CPI is not cool. Well, that is going to change things very drastically in terms of how the intraday positioning is going to play out. People who are betting on a big sharp move up, they're going to capitulate. That those big flows of calls that they were expecting, or that they bought in anticipation of this pump, well, when they sell those off, that means that the market makers, they don't have to hedge those anymore. So this can lead to the big intraday moves. So obviously FOMC, we talked about that. Obviously earnings as well. You have a company, everybody's anticipating and speculating, then boom, you have new data. So the market has to digest that. That changes to these or leads to these rapid changes. Same situation with geopolitical events. Geopolitical events are kind of like unexpected earnings reports for everything, or at least for whatever sectors they are kind of involved. Like the Venezuela invasion, that was kind of, you could almost look at that as an earnings report for Chevron. Really, it's just that big shakeup of positioning of everything else where there's new information and we all got to adapt in real time. So the spike in volatility, that changes the dealer hedging needs. So when the odds of some event change rapidly very fast, if I'm hedging this, if I'm providing insurance to some event that's changing in probability rapidly, well, that's going to lead to me pricing my insurance higher. It's going to definitely lead to me hedging more because, heck, if this thing happens that I didn't know was going to happen a day ago, I need to be prepared. That's how the market makers are looking at it. So these are kind of the mechanisms behind intraday regime changes. And now let's talk about how we can recognize them. So the first one we're going to be talking about is positive to negative, this gamma flip here. And before we get into it, I'm just going to catch up on comments real quick because I love that you guys keep on commenting. Bacaro, good to see you in here, brother. Hope you had a good week. Tyler's in some EL calls. Okay, that's interesting to me. Estee Lauder. I don't know. I can't speak French, but I know that they are consumer discretion. consumer discretionary, right? So they do what do they do? Makeup and like home goods, kind of like J&J almost, I want to say. I'll have to look into that more, but we can definitely look at that chart after we get through this if we got time. If we got time. Otherwise, tune in next week because we're gonna be doing more of the weekly roundups. Going on back through the comments here. Tyler mentioning Amazon dragging him all day. Oh no, had puts this morning from 240, holding through the weekend, hoping we break down again. Yeah, let's look at that after. Remind me if I forget, and we'll look at the Amazon chart. I think it's a good idea to go through all the mega caps because we were seeing some big weakness today in some of them. We saw Google having a little trouble, Apple really having trouble. So worth noting. We're gonna be. I don't want to. All right, I don't want to bury the lead too much. We're gonna be talking about not just this in a hypothetical context, but in the real context of what it means for SPY going into next week. So that'll be a great segue into some of these mega caps and other charts. So be sure to stick around for the end, boys and girls. We got good stuff here. Let me just hydrate real quick. All right, baby, let's go. There we go. So, positive to negative gamma flips. What are the signals? First off, we have that zero gamma that we're going to be keeping an eagle eye on. We would, if we're looking for the setup, we would be looking for a clean break below zero gamma, and we want to see that on more than average volume. So, my rule of thumb is always 1.5x the average volume on whatever time frame you're trading. So, for example, on a really big daily chart breakout, you know that when you look at the daily volume, it's going to be huge. It's going to be a big old volume stick. Well, you want to see it 1.5 times the average daily volume to show you that throughout the course of the day, this is sustained high volume and the move is likely to have follow through. So that same thing is just as valid for the exact same setup that's having the daily breakout on the 1 minute chart for that daily action. Think about this. So when that move starts, when the news hits the tape and there's the big push up, you want to see that stick on the 1 minute chart also have 1.5 times average volume on the 1 minute. And then that should lead to 1.5 times average volume on the 5 minute, and so on until you get to that 1.5 times average volume on the daily. So you see how like small time frame leads into bigger, bigger, bigger. Everything has to flip on the 1 minute first. But the impetus for that has been, the stage has been set on the higher time frame charts. So in the same way here, we're looking at the bigger picture and seeing, can we get the clean break below this zero gamma? Because if so, we are basically saying we are not in buy the dip mode. We are accelerating downwards, not gradual drift, acceleration downwards. So there's going to be wider candlestick ranges because volatility is going to be expanding. And this is a really good concept overall. I know I do this constantly, guys. Bear with me. These tangents have points, I swear. So just want to branch off really quick when we're talking about expanding volatility and what that means. So, for example, if you think that you are near the bottom of a range, for example, you're trading into zero gamma, but then you see volatility widening, you should be nervous. You should be thinking, hey, maybe I'm wrong. Maybe I should be ready for this range that I think is going to hold to break down. Because if it wasn't going to break down, if the range was going to hold, if this zero gamma was going to hold, we should be seeing a reduced amount of volatility into it. We want to see volatility tightening. We want to see compression on a stock that is under accumulation, because that shows that price at the zero gamma level, if I'm a buyer and there's a limited number of shares, like essentially I want to see the buyers being more and more willing to kind of chase the price up and catch any volatility down. And just like, remember, in a positive gamma environment, that's what market makers will be doing. So I want to see price action be doing that at the bottom of the range. I want to see price tightening up, and I want to see basically shares drying out at this price. So I want to see basically buyers being willing to chase them up and buy higher lows. So that's what the concept of a higher low kind of really is. It's buyers saying, hey, I think that this was a good buy before when we bottomed. Now it's coming back, and it's not coming back to where we really bottomed, but it's making a higher low, and I'm more willing to buy it here than I was to knife catch it before. And that is what support is going to kind of look like as it builds out. So just remember this, guys. Volatility expanding usually is a sign of range expansion as well, especially if it's at the end of a range. Think about it in the flip side. If you are breaking or testing a breakout and you make a new high, but then you come back a little bit and you make a higher low, and then you test the, the new high again, you come back a little bit, but each time you come back, it's a higher low. You're essentially kind of eating into this, you're digesting this resistance, and eventually you should pop through. So on the other side, if you're essentially, seeing expanding volatility at the bottom of the range, that's going to be pretty scary because you can just flush out of there really quickly. Okay, moving on. The volatility signals in particular for this positive to negative gamma flip that we're talking about, it's going to be looking like a big VIX spike. Maybe not 5%, but just a big spike in, maybe a 15, 30 hourly time frame. You're going to be basically expecting the projections of volatility in the next month to be spiking. And that's what VIX is. It's the next month out of volatility. So it's always forward looking like that. So when you get a range break, that probability spikes up, right? So that's what you're going to be looking for as one of the signs. With that increased volatility, you're going to see bid-ask spreads increase as well. So just like when we are trading up at the top of the range, ready to break through, when the shares are drying up, the spread's going to get tighter and tighter because there's going to be less and less people willing to part with their shares. And then, you're going to be kind of just digesting an upper resistance level. Eventually that upper resistance level should give out and you expand rapidly. So in the same way, you'll get the tight bid-ask spread and then the big expansion when you get the move. So volume will pick up to, I wrote 30% above average. I like 50% above average. It's arbitrary. The point is you want a substantial uptick in volume, so your own parameters, you can mess around with it. Somewhere in that 30 to 50% higher than average is going to show you that it's real. So these are the kind of dealer behavior clues that are going to be going on. So you'll be seeing more selling into weakness, and that represents dealers hedging short puts. So they're basically saying, okay, I'm short puts overall, but it seems like the market's going to fall. So I need to hedge those and sell into the weakness. And so stop runs are going to kind of accelerate. And that's essentially just the pushing action of just shaking people out of the market, pushing those stops out, running those stops as the volatility increases. And then market makers can essentially accumulate more shares at wherever they feel is a fair price, or hedge wherever they feel is a fair price, in anticipation of this next range that will be forming. So less buying support at previous support levels. This is going to be the same thing as just testing the same level, getting weaker and weaker and weaker. Here is how you should be responding if you do see this scenario playing out. So the first step is going to be just, you got to get out of the range trades. If the range is breaking and you're betting on mean reversion, you're wrong and it's going to be worse. It's going to get worse really fast, right? Because when you fail mean reversion, you continue trend. And when you continue trend through a range, that's not a position you want to be bag holding because you don't know how low it can go. And especially, this is really important, not just with Trade the Pool, but just about any prop firm out there. So there's always this kind of almost like an ideological, battle where it's like some people are like, why are there all these rules? And then the other people, usually the people who end up playing by the rules and doing really well, they realize the rules for these prop firms, they're almost always to keep the trader safe. It's not some scam, it's like, so you want to be able to essentially, the rule I'm thinking about is there's almost always you need a certain amount of ticks to lock in profit, right? So if I am sitting in a trade and it's working and I'm up over 10 ticks, then I put my stop loss at that 10 ticks. So if it comes back on me, I'm locking in a gain no matter what. So it's teaching me to practice just small gains, just building and compounding easy moves and not being at the whim of what the market may or may not do, but just taking the moves that they give you. And so the idea is that if I go red on something, I still need to make over 10 ticks in profit. So why would I bag hold? Why would I bag hold instead of getting out, saying I'm wrong, and then reassessing and then getting in at a lower price? So the 10 ticks I need is much more reasonable than up above my zero, my break-even price. So what may seem like a restrictive rule is really teaching you an amazing lesson. And my equity curve has gone up so much since I just started doing the same rule in all of my accounts, regardless of whether it's my own money or not. Just like, if I think I'm wrong and the trade was working and then I go red, I cut it. Unless I have a really good reason not to, I just cut it and I wait to get back in. So same process here. You got to exit your range trades. So the positions are essentially assuming that the support was at previous levels and that support failed. You gotta be a big kid about it. We press the buttons, we take the risk, and if the risk doesn't work, we gotta know when to cut the loss. Step two is going to be reduce position sizes in general. So we're going to get out of our range trades, and then if we take any new trades, we're going to cut the size down to 50 to maybe 7%, 70% of our normal size. Well, why do we do this? It's because volatility is now higher. Risk is going up. And this is super important. You can't trade with the same position size in every regime. You just can't do it. So if I'm in a positive regime, positive gamma regime, and we get a nice dip off of a key level and I think we're going higher, I'm looking to accumulate. That's when I size up. But if we're breaking ranges, I can just size super small because that's all I need. It's like when I trade small caps. Because generally when I trade small caps, I'm trading them to the downside because I'm a bummer. I want to rain on everybody's parade, right? I think there's more room to let the air out of a lot of these things if you can catch it. If I'm wrong, I get squeezed. So if I think a stock is breaking down, it squeezes from $2 to $8 or to $10. It goes over 10 and then it starts to lose 10. Say it goes to 10.50, loses 10, and on a back test, comes down, comes back up to 10. I get short there. My stop is just over the high day because if I'm wrong, I don't want to get blown out massively. If I'm right, though, this thing could go from $10 back to $5. Who knows? I only need a few shares to make that really worth my time and effort. So same process on a different, much, much smaller level when you're talking about indices. They're not going to dump 50% in a day like a small cap might, but the process and the concept remains the same. You cut when things are more volatile. When things are less volatile, you have the luxury of sizing up because things are manageable and predictable. Hey, DJ 2am, good to see you in the chat, man. Hope you're doing well. All right, so we're on to step 3. We got to flip to the momentum strategy. We were expecting range-bound price action. It didn't play out, so we change with the market. Now we're looking to play momentum to the downside. So we look for continuation shorts. We look for, okay, so we broke the low of the day. We're coming back up. Are we back testing zero gamma? Great place to short. Just be ready. If it surges way above, you got to respect that, hey, there's a chance that we're reclaiming it. We're going to talk about that more too. But if you get the big high volume flush of the previous range, pretty low probability that it reclaims. So the back test, it's a great place to look to get short. Then you get the continuation flush down. The range expands to the downside. What's going to happen? People are going to monetize their 0DTE puts. They got them. They're out there. When you get 100%, 200%, 300% move on a contract, you sell some. When you sell some, the market makers they get to take off the hedge, the counterparty, trade to that. So that'll lead to, like we said, negative gamma, the market maker hedging responsibilities shift rapidly. So you get the increased volatility, you get the big snapback pump up where everybody's like, oh, it's a fake breakdown. We're going to go all the way back up. Probably not. Probably just a little mean reversion back up to maybe a 9-minute moving average. I love using the back test of 9-minute or 21-minute moving averages for these to get involved in a momentum continuation play. So remember, when you're in momentum, you are trading with the direction, not against it. You use trailing stops because you don't know how far it's going to go. So there's two sides to this. I'm a relatively risk-averse trader, especially when I scalp. So I'm not only using trailing stops. If I get a big outsized candle, I'm going to take some off. If it comes back to my moving averages, maybe I add it back. But either way, whenever we surge up, then we start trading sideways, mixed tape, and then we surge up again. My new stop is under that previous area of mixed tape. Super, super basic, but it's super, super efficient, and it just works really well because you know what? It's using very basic principles. If we're in a momentum situation, we get a surge up, we reaccumulate for a small period of time, we push up higher. That's a great area to put your stop under the reaccumulation, because you're in from below. If you get stopped out, if those reaccumulating buyers fail, if they step out and it flushes, well, you have plenty of room to get out before your trade goes red. And you will if you put your stop under there. So step 4 is going to just be identifying the new gamma walls below. So if we lost the zero gamma, where is the next major support? And this is where it's going to be super important to watch these gamma exposure profiles intraday, because as the zero gamma level gets lost, you will see people capitulating on their 0DT calls that are above. When they take those off, the dealers don't have to hedge those anymore. Very often they'll take those off and they will be playing this momentum strategy. They'll be saying, hey, I'm wrong. It's okay, I'm wrong, but I'm going to make some money anyway. I'm going to take my positioning off, expecting us to go higher, and say, hey, now I'm going to expect us to go lower to the next support. You will see that on the gamma exposure profile chart. You'll see that lower level building out. You'll see the upper level shrinking. And that builds the confluence that no, we are not going to whip back and rip back up to those calls. Because if we were, they would have stayed on the tape. Very likely. Does that make sense, guys? Throw me a 1 in the chat if that makes sense. If you're following me. Hey, Talk. What's up, brother? Yeah, the GOAT, Tom Sosnoff, the original founder of Thinkorswim. Then he went off and started Tasty Trade, another great platform. Really good if you are an options seller. Theta Gang. My mortal enemy as a speculator. You're profiting off of my degeneracy. He's a great resource for anybody looking into the other side of the market. If you're tired of losing to the casino, why don't you become the casino? Go check out Tom Sosnoff stuff. It's got really good like long form content. I've watched probably 20, 30, 40 hours of his stuff. Just rambling on and on about credit spreads. Good stuff if you're that kind of nerd like me. Whoa, no, Talk. He sold Tasty Trade. He doesn't wear the beret. Was that like a brand thing? I don't know. I don't think I'd recognize Tom without the beret. That's such a signature look. Very few people can rock that. Hey, 1's in the chat. Thank you, guys. All right, that means we can keep on going. So let's talk about positive to negative, or let's talk about an example. I'm sorry, of this positive and negative. So picture this. Picture this. It is 10 a.m. SPY is trading at 585. The zero gamma is $5 below at 580. The trading range is 580 to 590. We're sitting in the middle of the range. We have good support at 580, $5 below. The call wall 590. Speculative buyers think that we can get that high. At 11:15, news hits. SPY breaks to 579 on big volume, 1.5x normal volume, guys. So we lost zero gamma at 580. 5 minutes later, we try to reclaim 580 and it fails, not once but twice. So you got 2 looks, 2 shakes at this because you're already ready for it because you see the level of interest, the 580, you see it get broken. Do you chase it? You don't need to chase it. Wait for the back test. That's your high probability spot. And you know what? Here's the thing with this, I think, is a really important lesson for any new or even intermediate traders, even advanced. You guys know this, but for anybody who's been doing this maybe under a few years, here's something that's really, really useful for you. Say, I'm one of these speculators thinking we're going to 590. When we lose the 580, first off, I'm going to just say I'm wrong. I'm going to kill the trade. Not going to go down with this ship. If we get the back test, we attempt to reclaim 580 and it fails, that's my shot to make my money back. I'm not trying to chase my money back. I'm just looking at things logically. The only reason I closed my trade is because I was wrong. I was wrong because this new setup may be playing out. If the new setup plays out, I'll take the shot there. I'm willing to flip sides. You got to move with the market. That being said, say worst case scenario, I'm positioned long. We get the sweep out on news under 579, under 580. We back test and I go short. And then it pushes down a little, but then it reclaims. Well, what am I going to do? Well, if everything is aligning up, maybe I realize I misread something. Like maybe the volume was only a little bit higher than average. Maybe the news headline was something that the market's going to end up digesting anyway. Maybe we're actually looking at a reclaim of that gamma flip. And we're going to talk about that scenario later because that is going to be the negative to positive flip. But the idea here is that, hey, if I need to take a second stop out and the market is showing me with this new information that actually, hey, no, we are catching, we are going up, we're reclaiming that zero gamma on higher volume than we lost it. Well, then you know what? Yeah, I may be out 2 stops, but I got something for those. I didn't get nothing for those. I got information for those. And that can help inform my next trade. So we never can just, I know it's like a big thing with traders, like you're only as good as your last trade. It's like, well, use you being wrong to help inform your edge going forward. That's what I always try to say. Like, figure out what you can learn from being wrong And when you're in a zero DTE situation like this, it can be literally instant, like, oh, I'm wrong right now. Well, that means that in 5 minutes, I might have a really nice setup to the other side. So just always be ready to pivot, guys. So I'm sorry, let me finish this example. So we attempt to reclaim the 580 twice. It fails twice. 5 minutes later, we close the 5 minute candle at 578.50, and VIX just spiked 7%. So guys, are we buying this dip? Give me a one in the chat if we're buying this dip. Give me a two in the chat if you don't want to touch this, and maybe you're looking short. What do we think? What do we think? We were at zero, above zero gamma in the middle of the range. We lost zero gamma. VIX spiking. VIX spiking. I'm not buying this. I don't know about you guys. I'm not buying it. So let's go on. Talk about the other side of it. What about a negative to positive gamma flip? What if that scenario we just talked about didn't play out? What if it wasn't very high volume and we did get the reclaim of 580 and it was just a shake and bake, shake them out on news that doesn't even matter, just a little bit of volatility in the tape to get some nice buys in? Well, then it would look like this. Strong reclaim of that zero gamma level with conviction. So again, remember, if maybe we're just not reading the tape very well, maybe the news hit and we're kind of panicky and we think it's high enough volume to warrant it, but then we see an even higher volume reclaim. Well, that's the nice thing. Sure, it can be a little subjective, right? I was like, are you looking for 30% higher than average? Are you looking for 50%? Who's to say? Well, if you get 30% down and 50% up, probably the 30% wasn't that important, right? So that's where you can use, sure, there's subjectivity here, but using comparative analysis can help remove some of that subjectivity and give you really good reference points, if that makes sense. Welcome, the Piper, all the way from London. Well, thank you so much. I appreciate you spending your morning with us. I don't know what time it is there, but whatever, whatever time it is, welcome, welcome. Welcome, welcome. All right. Oh, that's interesting. Yeah, talk. I was wondering about. I just was watching my watch list today. I wasn't really actively trading too much. I saw CEG down and GEV way up. So this is interesting. Because White House wants the power companies to actually pay for their own power generation. Huh. I gotta refer to in my community. We got 3 or 4 really good macro guys, and a lot of them are really well versed on valuations in this space. So I'm going to be really curious to hear their takes on this. In general, they're very bullish on both of them long term. Talon in particular, but there's regulatory risk apparently. So got to look into that a little bit closer. All right, Ross with the 2, he got the right answer. I love it. Okay, guys. So getting back into this negative to positive gamma flips. What are we looking for? So that 580 level in our hypothetical example, we get a strong reclaim on conviction, 1.2%, 120% of average volume on the way down, but then 140, 150, 170% on the way up, reclaiming that level with conviction. We love it. We love it. Okay, so price is going to hold above that zero gamma for an extended period of time now. We're not trying to rush in and grab it the very second it reclaims, because you know what? You know what it might be if you're just buying a reclaim on like 1 or 2 pennies. It might just be a back test that ends up failing and going down once that candle actually closes. So 20 minutes is a good average. I'm not going to sit here and pretend like I wait a full 20 minutes every time. The important thing is, again, this is it's kind of like the difference between cooking and baking. Like baking is a science. You just gotta follow the recipe. Otherwise, you're gonna have a big old mess. Well, there's a lot more subjectivity when it comes to seasoning a dish in general. Cooking in general, a lot of things can work together. There's I would say more nuance. So you got your hard rules that are baking, and those are more important, I feel like, when you're doing like zero DT stuff or any type of leverage. And then you got your you know, more like suggestions type things. So you don't have to wait for the full 20 minutes, but what you really need is a base to form. You need to find solid buyers being willing to absorb the sellers and eventually flip and take control from the sellers at this zone. So that's going to be looking like a rejection of the lower prices. So long wicks below coming back up. We love to see that when we refer to that as a failed auction down. So a failed auction is just we're bringing it back to market auction theory, which I think is the it should be a core component of anybody's technical analysis knowledge, and that's just basically saying that the whole market is supply and demand, and it's all a big auction. So if I bought a bunch of inventory, from some liquidation auction, some estate sale, whatever the heck, and I'm sitting on all this stuff, and then the market starts going up, I'm going to start selling it and selling it, selling it and selling it. And then, eventually there's not going to be the same demand. Demand's going to come down. And then when it comes down back to my buy zone, I might go, hey, might be time to load up again, right? It's like a shop flipping inventory. It's like it's all about that kind of thing. And so when we auction down and then price goes back up, it's basically saying, hey, this was a brief sale, and now the market is showing us that fair value is back up here. That's a sign that the fair value is probably higher. So that's always a good sign. Those long wicks below, and then like I said, the tightening range, volatility compressing, because we want to see the scaredness leave the market. We want to see on the big flush down in the reclaim. We already got the weak hands out. They already sold. That was why we flushed. And now the big, strong Chadley buyers, they're going, no, I was waiting for this. I buy, I hold, diamond hands, let's go, baby. And those are the buyers who can sustain the price move up because they're not going to sell on the first red candle because they got in at their price. They feel comfortable and their time frame is a longer, they have a longer horizon there. So, and sorry, actually going back, when I say longer horizon, like this is all in the context of a gamma flip intraday. So that longer horizon could literally be till tomorrow. But the whole point is that we're seeing an inflection point. And then, well, tomorrow, yeah, maybe they sell, but maybe those shares trade hands from that, intra week trader into an actual position trader, into a long term investor, into somebody like me I'm too tired to watch all of these stocks every single day, every penny. I set my alerts, and when they fill me off of key levels, I get in because I like the name, and then I hold until I'm proven wrong on a narrative level. So that's the kind of process of these scalps, these short term, failed auctions turning into longer term sustained moves. I'm rambling all over the place, guys. Let's reel it back in here. Let's get back on track. So when we are recognizing these negative to positive gamma flips in real time, the volatility signals are going to be like this. You're going to just like the opposite, instead of the big VIX spike, you're going to see VIX drop rapidly. They're going to take the air out. They're going to sell VIX ferociously to buy other things. So this is going to lead to the tightening of the bid-ask spreads because again, there is an understanding being made between the sellers and the buyers at this price. Sellers, we're trying to tell the buyers, hey guys, I don't know what you think, but we're going way down. Then buyers say, hey, chill. We're stabilizing here. We're coming to an agreement. This tightens the volatility. Then as the sellers start going, okay, fine. All right, fine. Okay, fine. The world isn't ending. We're not going to zero. Fine. I'll step out for now. Fine. Well, then the buyers are going, okay, you fumbled. I'm picking this up and I'm running it into the end zone here. Now we're going to expand upwards. That's the kind of general ebb and flow here. So volume normalizes or decreases. And so this is important, guys. So why are we looking for high volume in some situations and low volume in others? It's all about the context. So once we've had a high volume spike and reclaimed a key level, then we want to see the volume normalize and decrease because that is showing that shares at this value, at this price, are running out. The supply is limited. You better act now. Otherwise, you'll have to buy in higher. And that is the kind of game that we're looking for. That's the kind of setup that we're looking to play here. All right. Catching up on comments here. Oh, it's 10 at night? Why did I think it was 10 in the morning? That's how cultured I am. Well, appreciate you spending your Friday night with us, brother. I will be at the pub at 10 o'clock tonight, I think. So coming on down. Piper's talking about unloading gold. I'm looking to buy more miners. I don't know. I'm a little crazy though. I think the move is not done at all. But hey, it's been a wild ride this year. So this year we've been here 15 days. It's been a wild ride the past year and a half. So I have been locking in gains on metals, on especially silver miners, and then I go and look at the charts, and I go, hey, I actually I actually want to add these back, or maybe diversify a little. So I'm still in FSM full size. I still have a small position in HL and EXK, and still have a small position in AG. They're all just working, and my stops are well in green now. So I kind of think I should just stick with them. And as they continue to show accumulation into the highs of their ranges, I'm going to be looking to add in. So yeah, still love all of the metals. What did we do? We added a little bit of tech today off of 50. That is primarily a copper play. I think a lot of the laggards in the mining space could really start to catch on even more now. But we are seeing some differentiation. So love the metals trade still. If you know me, can you have my email? No. You can have my Discord, and you can have my you can DM me through there. I'd be happy to have you reach out and contact me through Discord, through Twitter, through anything like that. But not my email, because I'm too bad at checking that anyway. All right, guys, we're getting back on track. We're getting back on track. Oh, they always make me do these on a Friday afternoon when I'm so sleepy. That's okay though. Volatility signals. We're going to see a rapid drop. We're going to see the bid ask tighten and volume normalize and decrease as the shares at this price run out. Got to act fast. All right. Dealer behavior clues. We're going to be seeing the buying of the dips starting to appear. So we're going to be seeing a series of higher lows. We're going to be seeing more volume on the green push up out of the higher low than we are on the red push down from the previous push up. What else? We want to see that support establishing at the zero gamma level, and the selling pressure wants to be absorbed quickly, because the faster that we get out of the danger zone, this Kenny Loggins, it's the danger zone down there. We want to be up here. The faster we get out of there, the more it shows that these guys were wrong, that bears were wrong. We were just retesting, and now it's back off to the races here. So this is just the general concept of price acceptance. So if price goes down and stays down, it's finding acceptance there. That's bearish. If price goes up and it stays up, it's finding acceptance there. That's bullish. If price goes up and then it goes down, it got rejected. That's bearish, and vice versa. You get it. You get it. You guys are smart cookies. All right. How do you respond to this? Step one, you exit your momentum trades at zero gamma. If you were expecting a range breakdown and then you're freaking wrong and it rips back up on you, back into zero gamma, if it closes that candle over zero gamma, you got to take the loss. These are my least favorite stop outs to take, because I love taking momentum breakdown trades. I'm a bummer. I like raining on everybody else's parade. I like shorting small caps and stuff. So I like shorting the market in general, I'll be honest. So when I think we're getting a breakdown and then it reclaims, I got to accept that I'm wrong. And then I always want to just slam long. Usually it would have worked, but almost always it's the better move to wait for the pop through zero gamma, through my stop out level. I'm wrong. I don't know how fast it's going to squeeze. All I know is I got to get out. Then I wait for the back test on the zero gamma. If it holds there, then bada bing, bada boom. That's where I get in. And then you can get a really nice trade. But those are the ego bruise days. And those are the best days for me in terms of my trading development, my learning process, because I have to encounter something that I'm bad at, which is saying, hey, I know this is your favorite thing ever, but you're wrong. And now you got to make a little bit of money on mean reversion. And then you can still have a green day. Or you can just say, hey, I'm wrong. I'm not going to trade at all. That's also valid. The only thing you can't do is say, hey, I want this downward setup, so I'm going to keep hoping and praying that what I'm seeing with my eyes isn't true. That's you know my catchphrase. It's okay to be wrong. It's not okay to stay wrong. We gotta stick and move here. Talk, you want my email too? Let's see. Nobutako asking, is now a buy? That's a great question. Hang out till the end of this. I promise I will pull up the now chart. I won't clickbait you. I do not think it's a buy yet, but we can walk through the actual reasoning, and I can pull up the chart and all that in a little bit. I'm just not liking what I'm seeing in software as a service yet, guys. Like, I really would like to see a beat down basket that's been punished for a year. I would really like to see inflows, by this time into the new year. Nobody's buying these. They're selling more of them. So after we harvested our tax losses, selling our Adobes, selling our Nows, what did we do? Well, now we're selling them more, apparently. It's not a good look. Not a good look. Dumbutaku asking, how do you track gamma in Robinhood? And what time frame do you use to see if a stock is going up or down? Great questions. So you cannot track gamma in Robinhood. So gamma exposure is free information, but they're not going to give it to you very easily. I've built my own tool to help model that on an intraday basis. It, pulls data from Thinkorswim's live free. What's it called? ATP. I'm not a coder, guys. I struggled for a few weeks to put this together. But essentially, what it does is it pulls free data from Thinkorswim's platform and it uses that to update throughout the course of the day. There are services that do this. Unusual Whales is the biggest one. I have paid for them, and they're good content. We are not affiliated with them. Just my own personal opinion. That being said, you don't need it. Like I said, I made my own tool. The information is out there. I won't pitch my own book, but if you want my tool, come to my Discord. We can talk about it. I have a whole bunch of stuff there available. That being said, for free information, just Google around. I'm not sure who. I think Bar Charts has free information that might be updated at the end of the day. There is free live data. Thinkorswim, you can pull it from the API. That's what I'm looking for. The API there. If this is all a little bit above your head, don't worry. It is for most people. That's why these products exist. More importantly, that's why, I don't know, people like me exist who can kind of read this and put out the information for free as often as possible. Um, you badly need my help. Oh, okay. All right. How about this? Here is my Twitter handle at Steve Tileman, SteveTeilmann. So you can DM me there. I'll respond there. You can also come into my Discord server. If you look at my bio on Twitter, that's my Discord server. I'm in there constantly. That's the fastest way to get a response from me. I'm more than happy to help you with whatever you need. Just can't give out my email. So absolutely reach out. Either through Twitter, Discord, or Trade the Pool as well. You can ask in that Discord as well. What else? Did I buy ASTS at open? No, I wish. I did recommend buying it way, way, way lower. Rocket Lab at 55, ASTS maybe 70. I didn't even buy it though. I said it looked good. A lot of my followers bought it. I didn't. So full transparency, I missed a massive trade there on the space names. I am an RDW though. I am an RDW as my space name. That one's just starting, I do believe. You cannot track gamma on Webull either. So this is going to be second. I don't. Maybe they do have like some rudimentary tool now. I haven't seen anything. In general, it's going to be going paid soon. And I'm not affiliated with any of these guys. I'm just a retail trader telling you what I use. Gexstream.com, GEXSTREAM.com. That for, I don't know, might just be for another week or two, might be for another month or two. But it is free for now. So that's a nice, pretty interface one. Like I said, I also offer a dashboard through my Discord as well. So you just want to copy trade Dumbutaku. I see. Okay. Well, again, I feel bad pitching my book. I do offer a signal service, but you can find that in my Discord. But I really think that the best answer is to just learn how to fish for yourself, so to speak, because it's always a risk when you're just copy trading. And what we try to do here at Trade the Pool is teach people how to fish, so you guys can do this yourself. Because it warms my heart. It's the best feeling in the world. How many traders that I've taught things to, they come back and then they're teaching me all sorts of stuff. Like it's really cool. It's really cool. And you learn a ton from people who are really focused on learning, like we have in this community. So definitely stick around. You'll learn a ton. If you really want signals, I do those as well. Alrighty. Let's see. Did I miss any other comments? Yeah, Gex stream's good. Absolutely. So Tyler has CRM, Adobe, and Snow. F's in the chat for Tyler. I love you, brother. We'll look at those charts for you after this. We're wrapping up here. I do have a good amount more, so we'll see. We'll see how it goes. Okay, so guys, you get a choice. We are going to wrap up this little part for sure. If you guys would rather use the rest of this time to talk charts for the next week, I'm totally cool with that, and we can save the second half of this for in 2 weeks. Totally cool. 1 in the chat if you want to keep doing the gamma exposure stuff. 2 in the chat if you want to talk whatever charts you want to talk. We can pull them all up. We can do all the TA, all that fun stuff. 1 for gamma, 2 for charts. Let me know, guys. I'm gonna fill up my water and use the restroom real quick. I'll be back in 2 minutes. We'll tally those up, finish this up, and then we'll get going. All right, guys. All right. I see some twos. All right. Okay. Cleo, you want to look at charts? All right, let's look at some charts, guys. Let's look at some charts. So that means that in 2 weeks, guys, because every other week I do the weekly chart analysis, all that good stuff, letting you know exactly what I'm looking for the next week. So next week that is on tap. The next week after that, so every other week, we will be finishing up this gamma exposure one because I got more stuff for you guys. I got more to teach you here. Cleo. Okay, now she wants to cuddle. Now that I gotta focus. All right, we're getting back into it. So I'm gonna pull up my charts here. Bear with me just 1 second, and then we will get into the good stuff here. So, guys, you know the deal. Start getting me those tickers. We're gonna start with software as a service and space for Tyler and Dumbutaku here, and then we're gonna keep going. Ross, absolutely. You like charts? You like my? I appreciate that so much. Thank you so much. I'm not the best trader. I'm not the sharpest tool in in the shed. I can't even talk right half the time. But I've been told that I have a knack for communication, so I appreciate that a lot. I think that any idea that my dumb brain can grasp, I can then articulate it in a way that other people can understand. So that's the gist. SMR, absolutely. We're going to be talking about uranium for sure. There's a big area of interest. Also, quantum. I don't know if we got any quantum fans here, but it's on my watch list here. All right, let's get into it. I'm gonna have to take my screen down for just 1 sec. Okay. Give this the old share, and we're up and running. Dell, Marvel, we can do that. Zscaler, absolutely. Yeah, I looked at Zscaler today for the first time in about a month. Let's talk about it. Okay, get this full screen. There we go. First off, so hourly chart on the left, daily chart on the right. Excuse all of the clutter. But a few things I want to mention first off. So this is my path. I never move my paths once I draw them until they're very right or very wrong. And if they're very right, I'm not going to touch them because that's a little accolade that I keep on the chart. Anyways, thought we would get a push down a little deeper to 683 to 685. We got down to 686.30 and we bounced. I thought we would make a new high. We have not made a new high yet. So Am I right? Am I wrong? I don't know. We bought this dip. Not perfectly, but we bought it. I haven't sold anything from it though, so I'd like to get another push up. Excuse me. Anyways, let's get into some charts here. Starting off, we are going to go now CRM snow. But before that, IGV, because what is IGV? This is the index of software as a service. We're actually going to be moving to a weekly chart on the left here, just as we go over the high time frame stuff. And then if we like what we see, then we'll move this to an hourly on the left and we'll get into the nitty gritty. But IGV, what do we see? It was a cup and handle. It could not find traction here. Now we're seeing pretty large selling. For me, it's not that software as a service needs to go down. It's just that it is going down and it's not showing me a reason to buy it yet. This is the ETF. Oh, I see that I'm not linked up here. Right, still SPY. There, symbol. And now, there we go. Okay, so IGV. Weekly on the left, daily on the right. We just got pretty significant breakdown through this previous wick. See, that zone just got violated. We have a gap here that needs to fill. We have bad, poor structure way down here. This makes me think we need to go way down here. So we're going to zoom into the daily. Poor structure down here. We are failing up here. Another thing is this is another range in and of itself that we can track progress on as we negotiate. So we put a fib on here. We see the 50% fib is at 93.65. Our monthly trigger, long-term rising support. As you can see, this is where we caught cleanly the previous, not cleanly, but we did catch here and double bottomed off it very cleanly in the past. That was the long-term bottom, right? So I would imagine the long-term bottom, and when I'm saying long-term, I mean good for a swing trade, a position trade. I think it should be around here, this 50% retrace or this monthly trigger. Those two areas of confluence align with roughly the top of this base. See that? So this is one of Talk's famous, maybe it was the Crow, I forget. One of those two old guys, one of those two old OGs. They were talking about the George W. We're going to zoom in on the George W. Give you a little drawing. We got the W, and then there's your neckline. So this is what a base looks like. This is what a bottom looks like. This is what we push out of. Then eventually, we come back to this base. See? So very often, where the base neckline aligns with the rising long-term support, it will form a zone of confluence for a potential, say it with me, guys, higher low. So I'm not saying software as a service is going to zero. I do think sentiment is atrocious, very bad. And I will be honest, I don't think it's all unfounded. So it's kind of like the flip side of the AI bubble. Yes, AI is in a bubble. No, I'm not shorting AI. I'm long AI. Yes, software as a service is in trouble long term with just how strong the vibe coding push is and how much ability the individual Joe Schmo, Joe Sixpack has the ability to actually build cool stuff. That is increasing so fast that it trashes a lot of software as a service companies' moats. Like, all right, I'm being facetious here, but I'm also not. Can somebody tell me what Now does? What ServiceNow does? Can somebody tell me? Somebody tell me. You know, like if I don't even know off the top of my head, it's probably not that big of a moat. If everybody's vibe coding their butts off every weekend, they're building new cool stuff, and I'm sitting here going, why would I pay $20,000 a month for my business to have a ServiceNow or a CRM, account? I don't know. The W. Yeah, there we go. W. FCX, absolutely. I'm big in the copper miners and all the miners. Ooh, okay, Tree. We got some good tickers here. I gotta catch up, guys. I'm still on the first one here. But I think it's important when we're talking about software as a service. So I'm a vibe coder. I don't know what I'm doing, but I'm building some cool stuff. Therefore, I can't be too bullish on this, especially when we look at this is the more important chart. We're looking at SMH over IGV. So this is the relative strength of semiconductors to software, which is, when you think about it, it's the relative strength of hardware to software, which, when you think about it, is my whole 2026 thesis. We are entering the age of scarcity. Commodities go up. The most outperformance in tech and speculative growth areas are the commodities of tech, semiconductors, specifically memory. These things are in a super cycle, I do believe. They are bucking the traditional notion of the cyclicality of these sectors because the previous price history of the cyclicality of semiconductors does not take into account the massive push that AI creates. And it's not really just AI. AI is just the buzzword thing that is right now at the forefront of the whole tech speculative growth ethos, which is just growth for the sake of growth. For, like, who cares about how much money you're making? I want to see that target addressable market just grow and grow and grow. I want to see growth estimates grow more than I want to care about revenue. It took Amazon or Google or whoever the heck so long to be profitable, but they were a unicorn way before that. So in general, what was my point? My point was, in general, that I don't think semiconductors are stopping in the next couple of years. I don't think that it's going to be the same kind of cyclicality. Yes, the air will get let out of them. Micron will, in the future at some point, not be this insane stock that's going straight up and also their valuation is somehow going down, or, like, it's like holding well. Sorry, I got a neighborhood cat with a bell on it and he's staring at me from out my window. All right. Anyways, back to stocks. Did I mention that we're long MULL? We're long MULL. I don't think the memory play is over. So we were buying this week and it just broke out. That feels good. So what was I talking about? Okay, maybe you should ask service AI what ServiceNow does. Well, my whole point is that I don't think the moat is very good. I don't think the moat's very good. Also, you have the aspect of just liquidity leaving because it had a stock split. So where was the stock split? Guys, this is super important because this shows you that fundamentals don't matter nearly as much as positioning does, and as much as just the pure mechanical aspects of supply and demand. So we got the stock split. If you shorted the morning of the stock split, you would have been red for about 20 minutes, and you would now be sitting pretty up 20% on your short after breaking a range and looking like it can keep going. So high time frame on now, and then I promise, guys, I will power through. We'll get to all your charts. Keep them coming. I will let you know when the cutoff is. If you put a chart in, I will get to it at this point. So we broke this previous range, this previous high to low range. So this fib is now invalid. We draw it all the way back down to the higher time frame swing low. And what do we see? We puked the equilibrium. Very, very bearish. Very bearish. Can't buy that yet. So that being said, we are now in the area of interest where we could start to see buyers. Does that mean I'm buying? Nope. Nope. But everything is a sine wave. Every chart is a sine wave. Everything in life is a sine wave. There will be ups. There will be downs. There will be a big up for now. Where will it happen? Not sure. But where I start getting interested is a few key levels. So we're under the 0.62 fib. We are under the previous swing high. Till we reclaim this or this, can't be super, super bullish because this is kind of the neckline that we're looking at here. You can also see that it coincides with this previous push down before we surged up. We are under the 50 moving average on the monthly. On the weekly, we are under the 200 weekly moving average. That's the same thing, but whatever. We are just free falling. And this is high volume. And here's the thing. I'm not sure this could get, I think it needs to be higher volume than this that started the sell, because you want to see a crescendo of volume to see the bottom. So what I would say is that definitely not a buy here. The area of interest for me, since we failed the equilibrium, since we lost this swing low even, I think that the next area of interest for me has to be the exact level in which we broke out from. And that is going to be this zone right here. Just like that. And if we draw this back, it usually, is usually right about where the first push-up surges, comes down, surges above, comes back down, consolidates at this first surge point, then breaks out majorly. Then on the way back down, often where it needs to come back is a retest of this breakout. And it's no coincidence there. Why did it break out from here? Well, it was at the top of a big volume shelf. See this massive volume shelf on the left side of my screen here? The big old blob? So we popped above it. We came back down. When you reclaim this massive shelf, you surge. When you're floating up here and gravity's working against you, well, where is the actual buyer? Where are the actual buyers at? They're still sitting here. So we can draw this up to the top of the shelf, very clear top of the shelf there, and very clear bottom of the top of the shelf, bottom of the top of the range of the shelf. You know what I'm saying? At 109. So that's the next area of interest. Till it gets down there, I'm not even going to look at this thing. I said, somebody asked me up here if it was time to buy. I said, if this bounce holds, if this low holds, if it loses this low, get out of Dodge. Because we were trading into the higher time frame weekly resistance, but just the downward triggers were so, I'm sorry, this was monthly. Let me actually change that to make it a little clearer. This is my trigger system, not mine. I learned it from a very, very good trader podcast, or Trade the Zones. Now is doing something in finance, and you can't talk about trading with me anymore, and I'm sad. All right, let's see. There we go. I'm going to make this a little thicker. There we go. So this is the monthly rising support where we caught nicely before, and if we look back, see this thick line? When it reclaimed, that's when we started the big breakout. Lost it, reclaim, big move. We tried to reclaim right there. See, right here would have been a higher low from this. We failed. Failure. So now it has to flush out. It has to go back to deep support. That's kind of my view on most of these stocks. CRM was looking like it had better, was looking like it had better structure, but it was having a real hard time at this 260. And this is what we were mentioning, because last week I think we talked about this one. After this candle, it looks very promising, and then it was just doing this for a couple months. But last week I think we mentioned that this falling 50, it's just not looking super constructive when we're trading into this big flat area. So see, this is the top of the base. The top of the base failed to break out. Let's go back to now and compare. So down here, when this loads on the side, all right. So we see bottom of the base, right? When we break out of the top right here, see that right there? Put a big arrow there. Hold on. There we go. There's the top of the base. And as you can see, it coincides with the top of this big volume. So if you can push above, then you surge. If you can't, well, you're in trouble. See right here? So we're going to mark this out. See, I go to the top of the biggest part right there, and then I go down to the bottom of the biggest part. You could also go right there. That's fair. Either way, look what happened. We tried to break above, and we'll zoom in here. Tried to break above the yellow zone once, big failure. Twice, couldn't do anything, but held intermediate, short term, or decent support that was crossing over. Just a congestion of support, right? Of a volume, I should say. And so this makes complete sense. We have all these moving averages just bopping around. See all these levels on my chart that could potentially catch us. This coincides with all of this volume buildup here. But now what are we doing? We're rejecting and we're following this blue line down, the 50-day or 50-week, which is the 200-day. The 200-day moving average is pushing down, and we just puked hard off of this. So this is on the top of my focus list for a short. Guys, I think this looks terrible. And maybe this is me being naive, and this is too high quality of a company it's going to catch. But to me, this looks like a really brutal head and shoulders type setup. And to me, I think it wants to renegotiate the bottom of this. sweep out and probably go back down here, is what I'd really say. Long term, I wouldn't be looking at CRM for a long until it got all the way down to 160. Just being real with you guys, I do not see the trade here for a long. I definitely see it for a short. If it can break the low of last week, it just pukes to 200 psychological. Probably a small bounce back to let's draw a path. I think it's going to sweep the low, come back, just tag this. Maybe it comes up a little deeper to the 200 week. Then I think big push down to 200 and probably undercuts right there, then bounces to the low of the volume shelf. I'm looking at the left side here, this area, that big peak. Then I think it goes down here. So we'll check back in a couple weeks and see how this plays out. But this is kind of what it's looking like to me. It's a big descending triangle, and I'll draw out some support there. This is more valid, just this top part. So see the top part, that's holding stable. Every time it comes up there, it gets rejected. But the bottom, they're letting it fall more and more each time. So kind of thinking that it wants to let the bottom fall out. We're also seeing on the weekly that the oscillator's starting to turn over, and on the daily, it probably is already, well expanding down. All right, okay, guys. Promise. I'm going to go faster now. Okay, we talked CRM, we talked now. Let's talk snow and then move on. Another one that looks like a short to me. So I look at this as a bear flag. See that? And it back tested the 200-day and rejected pretty significantly. You can also just draw this as a flat resistance or support turned resistance right there. See that? Very clear zone that was support. Support, tried to break out, failed, lost it, back tested, probably going down. I think this is an easy trade down to 195 to 200. Specifically, all right, guys, here's another one. So the area of the breakout. We had the breakout. Well, when we fail, we're going to come right back down to the bottom of the breakout, the actual level that we broke out from. So that to me tells me that there is a gap. It's actually mostly an imbalance. Whoops. Just like this, that I think we really want to reach for. So I think that this comes down and retests this zone from 195 to 200. And we've got the rising monthly support there as well. If it's going to catch, it will bottom off of this, and it'll take a while, but it'll carve out a bottom, and it'll be a higher, or essentially a double bottom off of this swing low and off of this previous high. So see the support there? The resistance at this point flipped into support, probably needs to be retested. I got to say, this chart does not look like one that I would be interested in longing anytime soon, even though this support is not too far away. If it comes down here, to me, it looks like it could very easily just reject this and go much lower, clean up this very poor structure. And best case would be something like, what I think probably will play out is it comes back down here, then bounces to somewhere like there, and then eventually does that. Something like that. So there will be support here. I think the easy trade, take it right there, then cover the short and wait for it to come up and then reject off of like this blue daily trigger that's going to come down like that. Or maybe the rising, which will then be curling 200 day, which would go like this. See, we back test it there, bonk our head, and then sell off of that, short that for a new low, then wait for it to consolidate a little and just bottom out there. Okay, we are out of software as a service here, I do believe. SMR, let's talk about uranium adjacent plays. So URA on the daily here, really, really nice breakout of this four-day consolidation. This is the top of its volume shelf. So as long as we clear this 55.75, we can put that just like that. Then we're off to the races. And this is one that I think has a ton of room, absolute ton of room. Love charts like this. So I think URA, which is the ETF of uranium sector plays, is good for at least 30% before it makes a decision. It could reject up here at 71. Very possible. Regardless, these names are going up, and we're going to talk about a few of them. So these are the ones that we've been playing. You. It's actually more of a rare earth metals play than anything else, but absolute powerhouse. We were involved in this 15 area, right on the break of 15. So beautiful trade there. We already took some off at 20, letting the rest ride until this sweeps. Then we'll take another quarter off and leave the last half to quarter. I'm not sure. Maybe we'll take half off here, but leave the rest for the bigger push that could just keep going and going and going. Could be a 4 bag, could be higher. Love these names long term. Okay. You. Love this one. If it flags out again here, add more. Otherwise, just ride in the initial position here. UEC. Really nice downtrend line breakout here. And now we have the flat top breakout here. I'm expecting some shake and bake here. I'm holding the position, but wouldn't be surprised if it dips a little and we get a nice buy on this, as it basically makes a little handle here. So maybe it comes back down to 16 or so and then pushes up. Either way, I really like this one. We are still holding both. And this is one that I'm looking to add. LEU, Centrus Energy. So this one looks like it's 1 or 2 days behind UUUU. So I think Monday morning, I just buy this out of the gate. Just don't even worry about it, because I just want more uranium in the long port. Don't have enough exposure, and this one is just starting to really rock and roll here. So again, these names have insane room. We just have to wait for them to bottom. Since they bottomed, no worries. And just look, guys, this is why I'm looking to buy something that's up 500% in the last year or so. 700% since a year ago. Why would I want to buy this? Well, because I don't think it's done. And more importantly, look at this volume. Look at the accumulation volume. Just look at it. It's beautiful. Look at these giant green bars after years and years and years and years and years of doing nothing. Now people care again. Now people care, and it was clear that it was way oversold. Way oversold. So now we're coming back. We're reclaiming all of these big levels from years ago. We can push up much higher. This is the level that I think is really interesting. This 317.91, this previous big spike high where it went from $78 to $317 and then to $2. Guys, this went from $317 to $2 in like a year or two. They were wrong beating it this much. They're going to be wrong eventually, but I don't think they're wrong yet. I think this can go much higher. So Centrus, very cool. They're in the refining process, I do believe. Really like this chart, I gotta say. Man, looking so good. So I would just get in, and then my stop would be a close under 283. Rising 21 day, rising daily trigger, previous top of the base, top of the W. This is one I really like, and I'm actually going to put it in my focus list so I don't forget. Okay, if you want to play a little safer, SRUUF. This is the physical uranium. Well, is it even safer? It's just stronger, I guess. So, yeah, safer to play the underlying, I suppose. Very likely this is going much higher. Draw a big old channel like that. Say, hey, this is good for another 30%. And this is the underlying. Remember, if this does 30%, the miners do much more. Okay, gotta skirt back and see, make sure I'm not missing anything too major here. All right, so many comments. All right, we're gonna plow through some of these here. So SMR was the next on the list here. SMR, I'm sad about this one because I really wanted 1350. I was really stubborn about it. I was really stubborn about getting 1350. Got 14. I really wanted this 1373, 78 fib to get ran. Just didn't. So I'm a little salty, but it looks like it's ready to go again. So this is on the focus list as well. If this one wants to go, it'll just go like crazy. And what we'd be seeing is essentially a head and shoulders, inverted head and shoulders here. One of these. Really tight one here. And remember, we want to see the tightening volatility if a stock is bottoming. Remember what we just talked about for the gamma exposure stuff? Same deal here. So nice head and shoulders off a very important previous level. As you can see, I'm actually just going to mark out this zone, which actually matters. This is the neckline. And see, we're just peaking above it again. See this really high volume level here. And then we do have a little bit of one here too. So I think this is the next stop up here at 22. And very likely pushing much higher back to the 200-day or so for $30. Very logical level for it to come and tag there. Yeah. So that's the setup here. I really like this one as well. We put it in. It was in the short list because last time I was playing it was on the way down. Now we put it here. Any other of these uranium names I'm looking at? ASPI is interesting. This one's compelling as well. If it can reclaim the 200-day here, this one can rock and roll too. On a higher time frame, I think we're in a. Oh my god. Yeah, I didn't know what to do with this chart. You can see all sorts of weird. It's like, which of these channels is actually going to stick? How about none of them? Let's kill them all. There we go. High time frame, I think this is basing and going much higher. It's just a matter of how it gets there. But again, we stick to the system. I wish I had seen this. I kept this one off my list. But at 526, you see how closely that was? I think it literally held to the penny off the monthly trigger there. So the system works. I just got to pay more attention. Okay, what else do we got? OKLO. Let's do that one since we're into these uranium plays. This is the one that I called out and feel gutted over because I didn't get involved. I said, man, this look off the 200-day, probably a great place to buy. But the close on that day looked really bad, this wick. Then the next day I looked and it closed under it. So then I took it off my watch list. Then just up 40%, 50% cents, 60%. Very cool. But it came back and now it's holding the daily trigger that it flipped. So now it's a valid setup again. All of these ones are. All of these nuclear plays are still valid in my book. So OKLO, you get that one. You got SMR, NNE as well. This one's looking really nice. Really like this look. Still just right at this pivot from a billion years ago. And this high time frame chart's a little bit sus, to be honest. I don't know what to make of it. But back over key levels. What's the last one? SMR, NNE. I guess it's just those in OKLO. All right, moving on. We didn't talk Dell yet. Let's do Dell and Marvell. Monthly looks bearish on Dell. Looks like a double top that needs to push out further. We are catching the 200-day, I would assume. Just under the 200-day, but that looks like a bear flag to me. Let's see. So you had that. Broke that uptrend. And you could consider this a... Where's my cursor? There it is. You could consider this a little bear flag. And I think you can consider this a little bear flag. Upward fighting against the overall trajectory. See that? And to me, this looks like a head and shoulders. It's the eraser. Where's my drawing? There it is. This looks terrible to me. The only saving grace is it's at its like major point of control. So maybe it flushes out and then reclaims, and then no harm, no foul, I guess. But like to me, this looks very precarious considering it did what it needed to do up here, surged up, came up and rejected hard. Yeah, I don't like it. Gotta say, I don't like it. Might like it short. MRVL. This looks terrible. Why does this look terrible? It's a chip. So differentiation in chips, this is a mid to small, I guess mid cap chip. And man, this is just one of the most BS stocks ever. I do think it rewards long-term holders someday. But this is up there with XYZ and PayPal for the amount of times that a chart looked like it was going to go insane and then just failed. And to be fair, this one at least is pushing higher overall. It's higher than it was a couple of years ago compared to the other two. But it just loves just looking like it's going to make a major move, wiping out. Major move, wiping out. Major move, wiping out. Oh, this has got to be real. Oh no, we're going all the way back down. Probably pretty close to time to buy though. But I can't buy a chart like this. So we will look for the daily plus the monthly triggers at the previous level of breakout. See how that very often lines up, guys? There's where it broke out from, that little imbalance. And that's where our long-term support's coming up to. So that's the area of interest for me. Call it 75. All right. Zscaler. Starting to get back to a level of interest. Yeah, there's the level of interest. So this was the setup we took long last year. The break literally from right here, from 215. That's funny. I got in at 211. I remember this one. Yeah, 211. And boom. And we sold into 300 and into this, whatever this level was, the previous high. Oh, this imbalance right here that we sold into. 316. Ended up being just about the top. Now might be time again. Coming back into support, but I just need to see it reclaim. So here's the thing. I think this is a good place. I think that if in 5 years you said I longed Zscaler at 213.80, you'd be like, dang, that's a really good entry. I also think in 2 weeks' time, it's probably going to be trading about 213.80, give or take. Definitely under 230. I think this is going to take a while. I think it might pop, come down, and do something like that. I don't know if I'm patient enough. I think if you are patient enough, perfectly fine place to take a look. Perfectly fine place to take a look. For me, my system doesn't validate until it reclaims 230. And this moving average is curling on up. We are oversold on my oscillator up here, but still low-key expanding downwards. So no trade for me, but I understand why people are looking at it here for sure. And if you have a long-term perspective, totally fair. I gotta push back on the Dell and Marvell though talk. Maybe you're seeing something I'm not, but those look nasty to me. FCX. Love this one. Still in this one. Haven't touched it. Oh, I mentioned it. Crushes me. I mentioned it. I said it looks really good under 40. Did I buy it? Heck no, I didn't. I chased right around here, 46-ish. I chased a little more under 50, like 49-ish. Yeah. So I've got my position. Average is like 47, I think. Something like that. Still feels good. Could have felt better. Still not touching it. I haven't sold any yet. I should have. No. Here's my autofill at 61.29. That's my next level. Then all-time highs. Where are the all-time highs at? There we go. 63.55. Still massively bullish. And guys, I'll pull up you get the inside scoop of my 2026 portfolio composition here, how I'm building. So I'm going to drop the link for you guys, and you're more than welcome to check this out. And this is going to show you where my head's at for all sorts of themes. So show you that I'm not full of it when I said I've been bullish on these commodities for a very long time. Where's my copper section? Precious metals, down to drones. I must have missed it. Anyways, precious metals, coppers, they all fit in with our thesis very well. Okay, I can't find my copper apparently. I promise you it's in here. We'll get back to the charts. But regardless, we think this is a very long-term base, and I think I'll sell a lot of FCX at 100. That's where I think I'll sell a lot in maybe a year. Maybe a year. Something like Something like, might take more than a year, may take a couple years. But regardless, I think this one keeps on surging. I think copper is not done. We can look at the Sprott Copper Miners ETF and just boom, insane breakout. We can look at copper, the actual underlying, just starting major breakout. These are quarterly candles. Every 3 months, one of these sticks posts. This thing is insane. Look at the volume. Look at how high the average volume is. People are buying copper nonstop, and it's going to go higher. Strongly believe. Okay. Tyler, hope you're still around. I know this was half an hour ago at this point, but we are getting through these. I nod here. Not liking it, to be honest, but it is, well, okay, I don't hate it. I don't like the daily oscillator rolling over. I think it needs to take more time. I don't think it's ready to pop right now unless there's something I'm missing. Okay, the weekly is just starting to cross over. I do think it's in an uptrend and it just needs to consolidate here for a few more days. I think it's a buy off of the 59 handle to the 57 handle. I think that is your zone of interest, and it should hold this. Maybe it makes one more undercut to the 200, and you add a bunch there. But in general, I think high time frame, this is constructive. I forget what they do, but I know that a lot of people like this name. Crazy chart. I think as long as it holds the 200 day, I like it. Looking at, let's see, you talked about EL as well. Ooh, spicy. Okay, that's over its monthly trigger. That's a nice change of character. Oh, nice. My old crayons. I did not take this trade. Let's see how accurately these ones are. Where'd they go? There. Okay, so I drew it here. So I thought we'd get up here, come back, and push higher. So if you just move this over, didn't get it right on the time, but it did go roughly about here, came back to roughly about there, and it should proceed on to 125. I like it. The reclaim of this swooping monthly trigger is really important because that takes a while to progress, but once it does, it's off to the races usually. Tree, lending tree, very strong. Nice uptick on the weekly oscillator there, and this has a ton of room up. I think that it wants to go home up to 100. That's what I would think. So 100 is this previous big area of support where it then accumulated and pushed way off of. And it aligns perfectly with the monthly 200. That makes sense to me. So there's your target. I like lending tree. I might have to look into this one closer. I'm going to put it on my focus. Tree. Okay. Good look there. Nice. Going on down, going on down. Talk, I'm sorry. Dumbo Talk. I'm sorry this is late now. I hope you're still here. Working back through the comments. What price would you buy SMH? Is it not extended? It is extended. Absolutely. And this is where you gotta pick your spot and you gotta essentially have a strategy. So for me, I'm not in SMH, but I am in MU. It's a very similar chart. So where the heck do you buy something like this? Well, there were a few places. Basically, it consolidates and then it breaks range. And as long as it keeps consolidating and breaking range, you can keep buying it off of the rising moving averages. So my buy was, man, it looks good now. I didn't like bottom tick this either. Like I just saw that this triggered, like this alarm hit that the 9 filled, and then it was somewhere maybe up here, 331 by the time I saw it. And I just bought it there. So you don't have to be perfect. But in general, if a stock is really strong, it's going to act right. And it's going to give you a lot of places if you know where to look. So this one is so strong that this is actually the first day that it gave a look off the 9 moving average. And I mentioned in my newsletter, I don't know when to buy this. And I think I said this here. So like I ended up buying it higher than the price I called it out at. But this was the first time it offered a price where I could safely buy it into this and say, hey, if it closed the day under this, then I'll tap out and I'll wait and see. So it's hard to buy these high flyers because you have to practice risk management. You have to be willing to say, hey, if it closes under here, I'll wait till it comes down here and then I'll try again. Till it comes down here and I'll try again. So how do you buy something that's extended? Well, for SMH, the idea is that it is overbought on the daily for sure, but it is just breaking. It just broke out of this big pattern and then consolidated and is continuing. So if we look at the weekly, it's actually expanding. Sure, it's technically overbought, but something can stay overbought literally forever. You want to look at something that was overbought for a while? Palantir. So it turned overbought at $28 on the weekly chart. And it didn't, I mean, like, it was what? When the actual signal said, okay, it's a sell signal, quote unquote, according to this overbought, thing. It was 80 when they gave that signal. And then then it tripled almost from there, while RSI and the overbought conditions were actually cooling off. I'll give you another example here with NVIDIA. So it was technically overbought at $24. But then by the time it actually gave the, okay, we're overbought and we're going to have some kind of sell signal or some kind of reversion to the overbought, have that cool off. Well, it was a double from there. It was 45. And then what happened? Well, it stopped being overbought, but price didn't. Still trading at 40. It's just this cooled off. The oscillator cooled off. And then it's just straight triple, quadruple, So something can stay overbought for a very long time if the theme is good and if it's a range breakout. The same reason that NVIDIA went up like that is the same reason semiconductors are going up like that. AI, the trade is not over. The trade is this will be in our life until the world ends or until we have a utopia. It's AI is not AI slop. The actual underlying technology, when not being used for the lowest hanging fruit of capitalist, like like how can we make the most money right this second off of it? As soon as we actually have some foresight as a society and start using this as it's intended, the efficiency gains are going to be massive, continue to be massive. It's a game changer, just like the internet. This is all driven by semiconductors. When I see a chart like this, I can't tell you when it's going to stop. I can't tell you how high it's going to go. All I can tell you is that it doesn't look done. And this is what the best investors in the world say. George Soros says this. Druckenmiller says this. He says, when I see a bubble, I'm buying. I buy bubbles. I buy bubbles because I don't know when they're going to stop. I don't know when people are going to stop speculating, but I'm a speculator and I see the speculating, so I'm going to speculate with the crowd. That's what I would say. In terms of not a smart ass answer, actual specific levels, this is what I look at. When something is in a strong uptrend and I'm looking to get involved, here are my kind of parameters. I want to watch the 9-day. It's my blue line. And I want to watch the 21-day. And you can see I have this ribbon in between. So my buy zone is in this ribbon. For example, say I'm curious here, but I'm not pulling the trigger. Okay, we make a new high. Now I'm bullish, but I can't buy it up here, right? So I wait for it to come back down. I could buy it into here. I'd get stopped out, but then I'd buy it on the reclaim. And then here is the safer entry where it comes back in. And then that's where I'm looking. So in between this band of rising support. And then if the trade is really aggressive, maybe you buy it right into that 9-day, like the Micron that we're talking about. The Micron, you had to buy it right into that 9-day. Maybe it's a little bit more whippy. Let's see, I think this is an example. This one is a little more whippy on its way up. So it did lose that, but then you could always buy the reclaim. It lost it really briefly, but you could buy the reclaim of that kind of moving average cloud. So that's a good way to kind of track your progress on these high term flyers where it's like, okay, where the heck do I buy it? And where would I admit that I'm wrong? So here's the thing. We have this gap. Not all gaps have to be filled. See this breakout gap? Never filled. This one, tested, not filled. What I would want to see is, okay, first off, we're building up a little bit of a wall there. And then we have a little bit of a gap right here, and I'm going to make this blue. Okay, that didn't work. Give me 1 sec. There we go. So there's the low volume node. See this on the left side? There's the high volume node. And then on the right, see it's in yellow. And then there's this little gap here. That's the low volume node. So you can look for a wick back down, a whip back down into this. It'll be the rising 5-day moving average as well, this light gray. And essentially, that might be a place to get involved. If that fails, it might fill the gap. If it fills the gap, well, then you have a few other levels of interest. First off, see this high volume node here? There's the high volume node. And you have the 9-day moving average. So it might undercut, tap into here, and then you get your entry right there and it reclaims and it's back off to the races. So that's how you can get involved in these names that are kind of taken off without feeling like you're chasing too much. Let me give you another example. Velodyne or Velo 3D, I forget. This is one we've been in since 1650 to 17 was our buy area. And so this one, it's like, how the heck do I buy it up here? I bought it this day actually, and it came back on me. And then when it reclaimed, I bought a little more in the 1650 to 17 area. How could I do this? Well, the idea was I actually needed to be more patient, and I could have gotten my fill right here at the 1530. But the general idea was that I'm looking for an interaction with this previous swing high. So if we are in a squeezy upward trend, the narrative was very good for this one. It's they do 3D printing for drone parts, stuff like that. Very in demand, very sought after. So we came up here, we backed down, we surged above it, and I was trying to buy the back test here. See, 16 to 1650 was my level. Could have been more greedy and waited for that. But again, it's the same concept on the left here on this volume profile. You see this open window here, this low volume node. We change this to blue. Oh, whoops. Got to extend it. See, so there's the low volume node in blue. And that's why I was kind of looking for this node to be kind of back tested and then surge on above. So that was how I was able to get involved. And my stop would be under here. And that's a big stop, right? So there's the downside. You have to be willing to have like a 15, 20% stop, which means that I had to take a half size position on this because my usual stop is 8%. I'm only willing to risk 8% stop or an 8% loss of equity on a quote unquote full size position. So, I adjust my sizing based on that. This one had like twice the risk. So I put on half the size and then I trimmed into 20. Still kind of going, but I'm still holding a few. But the idea is you get involved on these rising moving averages or the back tests into these low volume nodes, that kind of thing. All right, since I am taking my sweet time here more than I meant to, because there's a lot to talk about on these charts, I am going to go to the bottom of the list and work my way up just so people who are here now can get a fast, they're not waiting 25 minutes for me to talk about their stock. So if I missed you, I apologize. Hang in there and we'll get to you. And probably got to put a cap on it here. So no more tickers, guys. No more tickers. I appreciate you. And definitely come back next week. We'll do the whole thing again. But let's go through some of these. We're going to do the thunder round because lightning round is probably copyrighted. So SMCI, wow, big powerful day today, big high volume break. And we did a few couple things here. So I had these two levels of interest. Zooming back out to figure out why their level of interest, because it's where we broke out from this amazing trade. This amazing trade that we were watching and called out on Twitter Live. Go check it out. Yeah, all the way back here in January of 2024. Wow, it's a long time ago. Anyways, crazy move that we caught there. And we're coming right back into that base again and starting to reclaim. Very interesting how that happens. Price has a very long memory. So a few things we can look at here. First off, broken the daily trigger, blue line there. Broken our cloud, the blue cloud there. When it's blue, we're in a downtrend. As you can see, though, we've got our lower part starting to curl up. This one's getting flatter and curling up less. So this is going to cross over very likely in the next couple of days, providing another aspect of confluence bullish for the bullish narrative. So where do we look for this? We pop a fib on the trading range. We look for a retest of the most important, which is going to be the 6-2 and the 5. So we see the falling support here on the weekly, the stair-step dark trigger there. Very likely when you have that and the monthly here and the 200-day there and the point of control there and the 50% of the fib here, this is going to be a big old fat target for them to reach up into. I don't know exactly which of these levels will be the important one, but I'd bet my bottom dollar that one of these gets filled. So probably a good spot to take a play here. What we can look at though, and what we might get stalled out at, is this 50-day sharply falling, very sharply falling. This is our first tap. We did find sellers there. So what I would say, we are bullish. We're looking for a higher low to buy. So I would be very interested off of this daily trigger here at 3150-ish. And if not, then down a little further at 30 to 3050. So the idea is that we would be bonking our head on this, come down, we catch the rising support, we consolidate a little bit, we back test this blue level, we pop above, showing an incentive to move higher, we then back test, go like that. And the idea here is that this is all working around this sharply falling area of resistance. So it would go like this, start to curl up. See? So we reject it. We catch on these ones, and these ones would be doing something like this. I'll change the color on that. And I will actually, just to make this concept really clear, this is red. Red is bad. Red is resistance. This is green. Green is good. Green is support. So see, we get the pinch between the high time frame sellers and the short time frame buyers. We are expecting these guys to hold more power because they have the big volume on their backs. They're the ones trading into a big long-term support level. So then we look for back test of the rising support. We digest that against this falling resistance. We say, get bent sellers. We back test and we prove get bent sellers, and then we rip up. And where do we go? We target up here, the resting liquidity higher. What are we doing this off of? The high volume shelf. See how all these ideas kind of come together no matter what chart we're looking at? Okay, great question here. I'm going to butcher your name. Bokuyeseka. I don't know how to say it, but I like it. Has a great question here. Why is 60% the most important? So first off, I'm going to give you the unfun answer. We have a full webinar on this. Go to youtube.com/trade the pool. Go to our playlist page. You'll see a whole playlist full of me, full of my face. Just power through seeing my face, and I swear there's good information in there. We have one in particular on Fibonacci ranges or Fibonacci retracements, something like that. Just search Fibonacci, trade the pool. I'll come up. It's going to be great resources there. But let's actually talk about what's going on really briefly. Whenever you have a range, swing high to a swing low, you got to define it, or you got to divide it. I can't talk. You got to divide it in some way, right? We have a range. We got to divide it. The most easiest way is in half. If you take it in half, it's very obviously just the 0.5 retrace here, and you'll see this play out very often. Price will come down, it'll come back to the 50%, then it will reject, or it will come back to the 50%, pull back a little bit, confirm, and then move on. But it's a level of interest. Why is it a level of interest? Because when you have any range, remember, this is market auction theory. We're just thinking about everything in terms of what is the level to buy, what is the level to sell. So here is our range. We buy at a discount. We buy when things are on sale. So somewhere in the bottom half. We sell when they're trading at a premium, somewhere in the top half. Ideally, here's the big idea. I know I'm a little all over the place. Bokuya Seika, here's the important part. We have a range. If we're going up, we have to digest this range in an efficient way. So it won't just go straight up. Instead of going just like this, very likely it'll do something like this. So the goal is to break up above this range. So very likely, first it'll come up here, then it'll come back down, then it'll come up here, then it'll come back down, it'll come up here, come up, see? So it needs to kind of digest this range. How does it do that? Well, there are levels that we can look for interaction at. Very, very often, when you have consolidation in a range, it will oscillate between 2 points within that range. It will be this kind of zone. See these two yellow lines? So between the 6.2 and the 7.8. And then I'm just going to flip these, reverse these, and you'll see the same thing in the bottom half of the zone, the 7.8 and the 6.2. So this is an important area for a couple of reasons. The general idea, though, is as we digest this price range, so the price range between this low and these highs up here, pull that fib up just a little. The idea is that we are going to do this in a way in which market makers can accumulate the most shares at the cheapest prices. And every time it pops too much, they'll sell some. But every time it comes back in a higher low, they'll buy more. So they're selling here, buying here, selling here, buying here, selling here, buying here, holding for the range break, and then they're selling up here. So the whole idea is when we were trading at a discount under the 50% of the current range, smart money is accumulating. And then whenever we get too ahead of ourselves, we sell, but then we rebuy it. So that's the kind of general idea. So why the 6.2 is super, super important is because of what it represents. It represents that price in this range on something that we think is going to be valued higher is trading, first off, under the 50%. It's trading at a discount. So this is something we want and it's on sale. But here's the thing. If you want something and it goes 25% off, you're like, hell yeah, it's 25% off. What if they drop it by 90%? Don't you kind of wonder, like, wow, maybe there's a reason. Maybe this thing is maybe there's a recall. Maybe, maybe it's dangerous. Maybe it's just like all of a sudden way inferior than another product. There's some reason there's a fire sale on it, right? So that's the concept. You don't want to just buy something just because it's cheap. Because, hey, what if we're going, hey, here's the fair value at 45. So 44 is on sale. 43 is on sale, even more. 42, great price. What if it's trading at 12? Do we still want it? I don't want it. I don't know what it's doing. Why is it trading at 12? That's a totally different product at that point. We don't know what's going on. So this 60%, more importantly, the 6.2 down to the 7.8, this represents the optimal pullback mathematically, the optimal mathematical pullback for an entry for this long trade up and out through the range. So this is called the golden pocket. This 0.62 fib is very important. And there's two schools of thought. The first is the most obvious, the most simple. This is an OG trading tool. A lot of old school people have this on their screen. When everybody has it on their screen, the levels respond. It's a self-fulfilling prophecy. There is a more fun explanation. I'll leave it up to you whether it's valid or not, but the golden ratio is a sequence of numbers in a certain mathematical layout, which propagates very often in the natural world. You will see it in the ratio of petals and flowers on a sunflower, for example. When you see that spiral, the nautilus shell, that's a golden ratio. And all of that is basically encoded in these Fibonacci levels. This 0.62, this 0.78, this 0.382, this 0.236. These are all incremental levels that the universe tends to like to kind of play out in for whatever reason. I don't know. I mean, like, for example, carbon is a 8-sided molecule, and you see that structure a lot in nature, like a honeycomb, for example. So, you have the building blocks in one shape, the things that the building blocks make end up playing out in certain shapes. So that's the more esoteric, hippy-dippy, fun explanation for why these levels matter, because it's the universal truth. It's the secret of the universe, yada, yada. Who the heck cares? All I know is they work, and I put them on my screen and I make money from them. So that's why the 6.2 is important. And boy, howdy, did I ramble on that one. Sorry, guys. I don't know how I didn't lose 1 billion viewers there, but thank you for listening. So hope that answers the question just a little bit. We're going to keep on moving our way up. Teradyne, TER. This has been a long-term holder for ours, and boy, howdy, every time I look, it's just beautiful. You can see, where did my trade thing go there? There it is. So you can see where we entered. We got in at 134, currently trading for 228. So we're up 73% on this. Not a whole position. We got out over here 162 and here 170, just holding about a quarter left, if that. And actually I only have like a few shares of this one because I moved it over to the other one that I love in this space, AMKR. This one again, we got in the 23, 24s, I think. Yeah, in this consolidation range here. So guys, don't sleep on these setups. When I have a high conviction one, they often just kind of go. It's very stress-free. So this is kind of my bread and butter, these kinds of setups here. Thematically, it ticked all the boxes. Teradyne and Amcor, essentially, they're targeting exactly what I was looking for in my middle innings AI plays. So I was looking to target packaging, target supply chain constrictions and bottlenecks. So these guys essentially they're in various sub stages of this packaging and testing process. Another great one, I did not play this one, but I might get involved. Still got a ton of room. This is air. They're basically, they test the wafers. So what they do is they have like easy bake ovens for semiconductor wafers where you bake them and then you can see if there's burnout without having to like, I don't know how it works exactly, but they save a lot of money by testing for burnout. And I'm pretty sure they make easy bake ovens for semiconductors. So as you can see, I've been in this one, I'm in and out of this one for years now. Very heavily traded chart. But essentially what we're seeing with all these esoteric letters and everything, this is a Wyckoff accumulation diagram. And now we have, I got to add let's make a duplicate of this because we got to add our newest label here. That is a sign of strength. There it goes. So the sign of strength is when it comes up to the previous center of the George W. The previous center of the bottom of the range. So we'll draw it out nice and dark there. We have the George W base. The 1, 2, 1, boom. There's our neckline. What do we see? A double bottom off of our neckline forming a cup from this handle. The classic cup and handle pattern. What is this pattern actually telling us? The cup and handle pattern is telling us that we have established a range. That's what the cup is. We had a level that was important. We lost it. We traded under it for a while. We came back up. We reclaimed that level. This is all a base. We find we seek price expansion out of the range. We enter price discovery up here till we find sellers. Sellers beat us back down. Where do they beat us back down to? To the neckline, to the established support. We test it once, we bounce. We test it twice. What do we have here now, guys? If I'm boring, it means I'm doing my job well because I'm showing you how easily repeatable this stuff is. George W. Bush. What do we got? We got the same W right here. Same base break right here. What do we look for? We look for the back test into our neckline. Woo. All right. That's my John Madden segment here on air semiconductor testing. Really like this one. So we add this to the focus list too. There are so many setups, guys. There's so many setups. Only play the best when there's this many good setups. Play the best and play some from each sector that you think is going to do well. Alrighty. Wing stop. The bane of my friend's existence when he tried to short it from 200 to 400. I don't think this thing's done. Let me kill these old lines, though. Sometimes you got to start fresh. There's resistance. There is support. We have a pennant. Good enough. What do we do next? We define our range and see where we are within it. It's the wrong way. Reverse. There we go. And see, guys, fibs really help you find your bearings in a range. So what do we kind of see when we frame it with these few little lines that we just drew? Well, we're in a consolidating pattern. Overall, still in an uptrend. This 200-week moving average still moving up. It caught us last time in a big consolidation sideways move before a surge up. It is now formed a valid double bottom here. Got that. Got that. So we're building a narrative. We're building a case. We're detectives here. So now we look at the volume. Big volume spike right here. So whenever there's a candle with exceptionally high volume, this is like double the average volume. Well, I think that is worth marking out on the chart. So you go like that, you draw a little rectangle out, and this is going to be your base. Very often when you pull this back, there's a reason. See, it's just where it consolidated before. That's where buyers re-stepped in and pushed us up. Now we are testing an interesting level here. So look, guys, I'm going to do it again. What shape is he going to draw? Who's that Pokemon? What did we do when we bottomed here? We came down, we came up, we came down, we came up. What are we doing here? We came down, we came up, we came down. We're coming up. What are we doing here? We came down, we came up, we came down. We come up. Fractals. One shape inside of a bigger shape, inside of a bigger shape. It's all the same thing, guys. For bullish, you'll keep seeing these same shapes just appear. So now we have this smaller W in the bottom of the larger W. This is a really nice long setup. We have the confluence of the big bulls here, and now I got to add another one to my focus list, guys. I'm not going to have a weekend at this point. I'm just going to be looking at charts the whole time. I love it, though. Wing. Good look, Tyler. Good look putting this on my radar. So, and again, I just want to clarify, it's not about any one system, any one pattern. But notice how all of these different systems or tools that I'm giving you are all showing to build the same thing. My trigger system, it's all consolidating right here at the neckline of this W. We talked about the wick back into the higher low. We talked about these rising trend lines. We talked about the intermediary point in the fibs, this 50%, where things are offered at a discount. When you see the beach ball underwater, when people are buying it up every time it's at a sale, on sale. All of these things come together, and it's not about any one system being the end all be all, the holy grail. It's about when you have a little bit of knowledge in all of these different areas, you can stack them, and you can just stack that confluence and get a really high probability setup where any one of these indicators might have a 40, 50, 60% top win rate, but you add them all together and you start actually defining real edge. All right. Oh, well, thank you, Tyler. Appreciate you. Dumtaku snaps. Okay, this is the last one. I said no more, but you're new here, so welcome. Let's do snaps. SNPS. Synopsis, is that what this is? I don't know why I call it snaps. Synopsis. Well, you may be new, but I think you're catching on fast because this is a look that I like. Because what are we seeing? We're seeing it coming down. Whoops. There's my tool. Coming down, coming up, coming down, coming up. So the same W pattern. We have this range, this base, and really it's over this part right here. And now we're starting to consolidate and push higher. So I do think that the target is going to be up at this neckline, 600, to be safe. And once you reach there, and if you don't look like you're rejecting super hard, then you get to play for the range extension. We slap our Fibonacci code on here, or Fibonacci extensions on here, and this is the area where the rubber hits the road, the 1.27 fib. Why does he care about these arbitrary random decimal points? Great question. Well, this is just one of those Fibonacci extensions where it seems very, very, very common for if this W pattern is going to fail. No patterns always work, right? That's the game we play. It's a matter of probabilities every single time we enter a single thing in the market. Nothing will ever be 100% with TA because TA is backwards looking. We are looking at all of the data and all the patterns that we have access to up till this very moment in time and using that to project a potential path forward. Every single new bit of data that does not fit with what happened prior, which could literally be anything super minor, anything major, of course, but every little bit of new data will change that trajectory that we're modeling forward. So you always got to be willing to pivot. But that being said, just because past returns are not indicative of future returns doesn't mean that there isn't a correlation, right? So we got to be aware of what's going on like this. This is all to say this 1.27 level is an incredibly common level where if the breakout, this pattern, is going to reject, this is the area where you'll see the sellers stop it. If it fails to get stopped here, very, very, very often it surges to the 1.62 extension. If it fails to find sellers here, it'll reaccumulate and push for the measured move of 2 times the base that it's breaking out of. And then almost everybody, from an institutional, from a mathematical, from a quantitative perspective, will recognize that it's time to de-risk. There will be natural selling at these breakpoints. Natural selling gives sellers an area, actual new sellers an area to try to short as well. It provides a break in the momentum. So these are the breakpoints. These are the areas you watch. Almost always you'll get reactions at these levels. Sure thing. Absolutely. Thanks for hanging out, Dumtaku. Welcome, welcome, welcome. All right, moving on back here. One more question from you. Absolutely. Keep asking questions. More than happy to. So at what support level can one get into SMH? So let's double go over this just again. I forget what I said already, but I know it was those rising moving averages. Yeah. So there's this low volume here. You can watch 393 to 394. 393 to 395. That's the first zone where you might see buyers respond there. If you do see buyers responding there, and remember, we're looking for higher than average volume. So whatever time frame you're looking at, intraday, I'd recommend maybe as low as a 5-minute, as high as an hourly, somewhere in there. And you can see if we are essentially putting in higher than average volume. So just to refresh anybody's memory, you can do this really easily. See my volume on the bottom here? I have a moving average right on there. So into my settings here, I have a 20 length moving average on my volume. So then just at a glance, I know this candle is about 30% higher than average volume. This candle is about 10, 20% higher, and it's very easy to say at a glance when we look for the breakout candles, wow, look at this breakout candle. It's almost twice, it's just over twice average volume. And this big sell candle is over twice average volume too. So that made this level an area to watch. When we lost it and reclaimed it on this other high volume day, especially on even higher volume, this is when we got bullish. You can see this old path that didn't play out. And what stopped this old path from playing out, see, we did get the push right up there and the push down. But why it didn't play out is because this big buyer stepped back in and reclaimed the level that was formed from this big seller and this big seller. So that's kind of the gist of that's kind of the why behind the supports. In terms of exact levels, yeah, we're looking for this 395 to hold and find buyers. If it doesn't, then the better place is going to be this 390 handle because the 9-day moving average will meet up with that. And then you're trading back into this big shelf. So I would say 91.60 to 390. That's the area where I would like to get involved. But again, I'm not playing this one particularly myself just because I'm in MU from, call it 335, probably 333-ish, something like that. So that's kind of where my head's at with those guys there. Okay, going on back up. See if I missed any here. Oh boy. Ross, if you're still here, I'm sorry I missed this one. Can I briefly explain why uranium is such a big deal? Absolutely. So, uranium. Uranium is hard to mine. There's not a lot of it, and there hasn't been a big incentive to push for mining uranium because of all of the post-Fukushima FUD, fear, and just doom around the narrative. Uranium, the lack of interest in uranium up to this point, I attribute to political There's probably a better word than cowardice. Basically, I think that nuclear is scary to people who don't understand what nuclear is. Therefore, it's a tough sell for politicians. Therefore, it's so much easier to not do it. We saw this very come to a head very relevantly in a couple of years ago in Europe after, in the fallout of the Ukraine Russia war, when there was a massive issue with Europeans not having access to, heating sources like natural. It was a natural gas shortage, and it was really crazy. And the only reason they got to that point was a lot of legislation that was very anti-nuclear. I believe that Germany shut down a nuclear power plant, stuff like that, where it's like, okay, well, if we actually have a shortage, it won't go well. So this is just to say that long term, there is a structural shortage of uranium. We need more to hit our timelines for all of the reactors that we already have, let alone the massive push for new reactors that we're seeing, and just energy demand in general that's just rapidly upticked. This is all compounding with the fact that when private capital is in charge of infrastructure primarily, this isn't like the 1940s where the United States government was pushing for most of this infrastructure. It's mostly private companies, private corporations that are pushing for the growth of these, for the making, the building out of these big manufacturing plants, these big data centers, for example. So because of this, there was no incentive to upgrade our electrical grid until all of a sudden, oh my God, we all need AI slop. I don't know what our parents are going to do if they can't forward me 10 different AI memes a day. Jeez Louise. That's good thing that that's where all of our water is going to, right? Anyways, I'll stop being jaded. The point is that it's just long-term structural, like, there's no way around it. We need more energy. We've postponed this so epically out of proportion, upgrading our power grid, upgrading our infrastructure as a whole, until it was, the most financially viable for the biggest companies or whatever. Regardless, we need alternative sources of energy. Coal dying, energy or oil, it's not sustainable. Solar, it's not there yet. What are our real choices? Natural gas, yes. I think that's going to be a big component, but uranium is really, I feel like it has to kind of be the backbone if we're thinking long term about how we maintain this structure that we've kind of built. Um, that's one aspect of the bull case. There's more to it for sure. You have a situation specific to the, what is it, the Indian Lake mine. That's CCJ's biggest one. I believe that one, like, we're still dealing with the fallout of that mine closing in terms of how that has shut down uranium supply, and demand is just keeps going up. So let me go way back. Oh wow, that was so long ago now. Okay, the was it Cigar Lake, Indian Lake? I forget exactly what it's called. So there's a massive mine. Sorry, hold on a sec. I'm trying to catch up. Talk is probably, he should be giving this talk. I'm a tourist who just likes these tickers. I haven't actually looked at the fundamentals in probably a year or two now. So I gotta do the brush up stuff for sure. But in general, I see no way that we can maintain this build out of like what we'd like to do with AI, what we'd like to do with just energy and our grid in general, without a massive amount of relying on building out of these facilities. So the moonshots are going to be the small scale nuclear reactors like SMR. These ones are going to go to zero, or they're going to go to 100 plus. The ones that are trading like 20 to 50. These ones, it's a much higher time frame, and it's kind of in the same way that you will see the more profitable uranium miners like CCJ strongly outperform way before you see the speculative ones, which still are years away from reaching that level of growth. Although this chart makes me want to puke. I was hunting this one from 750 to 8. Let's call it 7 to 8. I got stopped out, and now it's ripping like crazy. NXE, they do small scale reactors and mining. They have some mines that are just starting to be developed, I believe. So still quite a ways out. But even like the CCJs, the bigger ones, like it's just the future is bright and the market's just starting to kind of catch up. What else? What else? Yeah, people invest to front run it. Absolutely. 3 years to fill uranium orders from cake to bake. Absolutely. It takes so darn long. And let's see. Can I look at actual spot uranium on here? Let's see. I can. Let me go to the monthly. This is a supply squeeze. I mean, so guys, here's the whole thing. Age of scarcity. I won't shut up about it. We need real things to build cool stuff. Everybody wants to build cool stuff. Everybody's all talking about the AI and stuff. Okay, how are we going to build this stuff? Steel, copper, uranium's going to power it. Natural gas probably going to power it. And all types of energy is what we need. So essentially, I think that we are entering the golden age of energy. XLE on the monthly chart. Imagine being an XLE, an energy investor for the past 15 years. It's done nothing. Why don't we look at tech in the past 15 years? It's done something. I don't know. I think all trends are mean reverting to some extent or another. Sure, seeing the narrative building up for energy dominance. That being said, oil dominance, much less sure. But hey, I'd be fine if Trump killed the oil industry and we transitioned to other things, to be honest. If he said no buybacks in this dying industry, you can't return value to shareholders. You got to drill, baby, drill. Okay, well, oil companies get punished and everything else needs to kind of make up for it, I guess. I don't know, still ballpark in that aspect of the thesis. But regardless, can't be bearish on energy overall. Uranium's number one. I still like vertically integrated names like GEV. Oh, nice. This one caught nicely. Didn't see this week. Beautiful, beautiful. And this is back on the focus for an ad. I think I should have added when it came down here. I just didn't like how it puked my levels. And I should have watched the past couple days when it reclaimed here. I think that was the buy. So I'll have to be a little bit disciplined here, but I think that this is working its way back on up and out. Still looks really good to me. But hey, I didn't panic sell. Yeah, there's our pivot. So watch the 675-ish handle, right around 675 to 680 next week. If it can hold above there, moving averages should curl up. This should be a really nice flag. And essentially what we're seeing is another cup and handle. Something like that. Hey, Black Mamba. All right, you missed earlier because I talked about both of these. I'll go back over them for you because I love both of them. And I'm in one, and I'm looking to get in the other. LEU, I'm looking to get in Monday. Probably darn near it open. If it comes back to 320, that'd be nice. If it breaks through 335, that'd be nice. I think 325 is a nice level that I'd like to buy a back test and reclaim of. I'm a very big uranium bull. I think this is a very interesting name, very high beta in the space. If uranium surges, this was the previous leader. It should catch on up. Hey. All right. So FCX, love copper, been loving copper. By the way, Black Mamba, scroll on up, maybe about an hour up, you'll see I dropped a link, and that is it's a Google Drives link, and that's for my year going forward, my overall thesis and where my head's at. Massively bullish on copper. When you have a chart like this, it's like, okay, it's got to pull back at some time and I can add more. But I can't sell because on the higher time frame, it still looks so good, like it's just about to start breaking out. And I can't really buy more quite yet because it's kind of just straight up. So I'm waiting for it to flag out a little bit, maybe into these all-time highs, probably pops the all-time highs next month. Starts maybe a month or two of consolidation. I'd love that, and I'd love to get adding in there. If it flushed out nicely, that would be cool. If it squeezed and back tested harder, because then it kind of speed runs this progression. I don't have to wait as long, and I can buy a deeper discount, maybe at the 55 handle. Either way, absolutely love copper. Dr. Copper leads the way forward. And guys, I don't know if you've heard it, but we're running it hot. We're running it hot. This is the age of grift. I don't care how you feel about it. We're going up. That being said, metals definitely a top watch for me. Awesome. Yeah, break and retest waiting. Absolutely. So we are in FCX. We're also in ERO. This I consider a higher quality. Also doesn't have the headroom over it, or the overhead pressure over it like FCX still does. This one's breaking out in blue skies. And guys, this is the chart. This is the chart. You'll see a lot of these if you look through my picks for the next year. This is the setup. Long-term, high time frame, big multi-year base. We're talking 5 years of consolidation, breaking out. This is what commodities are doing, guys. What else? AA, I think, aluminum. This one's a laggard. Aluminum's lagging, but still, see, sideways action for so darn long. When these start to move up, they have a lot of room. Just like the junior silver miners. We've been in this one since the flat top range break. And this is what I'm talking about, guys. So when we're talking copper, these copper miners, we are right here. I'll put an arrow for you. You are here. Is that the time to short? Heck no. Is that the time to buy? Maybe not right this second. In this range, though. In this range, yes. Not a bad price to buy. You just might get dragged a little bit, might get chopped a little bit. But if you're a long-term position trader, better to be in here than not in at all on names like FCX. See, right under the long-term base. We go back to the silver miners. Whoops. Right back under this big base. And that's why I love them. So then I look at some of my favorite positions in silver right now. They are doing that exact same thing. FSM, the silver miner, we've been in since 950. This was our last pickup for silver miners. Most of the other ones we picked up way down here, but I wanted more exposure. So I was looking for charts that were doing this same darn thing as the overall index was, breaking out of a 5 to 10 year range. Black Mamba's preaching. Black Mamba's spitting right here. All-time highs bring new all-time highs. It sounds crazy, but that's the facts. You know what I hear whenever somebody says that's too high, I'm going to sell it. That's a new 52-week high, I'm going to sell it. I'm going to short that. It's up 50% in a year, and it's the highest price it's ever been in. That sounds like dangerous behavior. That's what I think. I am holding shares. I'm all out of my options on silver. We played the silver squeeze with options from like 55 to 65. And I was like, all right, I made my money. That's enough. I don't know where it's going. I probably should have kept rolling that one, huh? But the way I justified it is that, hey, I got a nice juiced trade on options. I don't know what it's going to do. And I've got my shares. So shares still cooking. Wish I held the options. So I'm in FSM. I've diversified some from being heavier in silver to a little more gold because I expect just a little more of outperformance in gold midterm before silver continues its absolute dominance. So I'll be kind of trading back and forth between these baskets, but I was low on gold. I had a lot of silver. So I took some silver off. I took some of EXK off. I still love this chart. But like I said, I'm in from 675 and it's a double just about. So took that off, holding half of that. And HL, this has been the best performing one. Oh, wow, it's still going crazy. Last time I looked, it was up 100%. Now we're up 155%. Oh my goodness. So that's what I'm talking about. When you break these long-term structures, just holy moly, you catch insane moves. So this one we are in from 1611, currently trading for, no, I'm sorry, not 16. We're up $16. We're in from 1041. It's 2650. And then you zoom out, these are quarterly candles. Does this chart look done to you guys? Doesn't look done to me. Looks like someday it's going to be trading a lot higher. So where do we trim though? Realistically, I got to take more off when we sweep this right here. So that's coming up real quick. It actually 2650, 2686. We swept it after hours here. So on Monday, I will have to sell some. Wow. Okay. Well, I'm in a good mood. All right. So yeah, I have to keep this in another count because if I look at this every day, there's no way I'll hold it for 150%. I'm a human, you know? So boom. All right, Black Mamba, what did you do? Caught the craziest play on gold feuds from 37 to 50 till now, still holding. All right, let's look at GLD feuds here. That's not going to be at GC. That's what I need. Sheesh, look at it go. All right. Black Mamba was in from 37.50. Wow. All right. 37.50. Okay. So you saw it break out, missed this probably, but said, hey, I'm not missing the rest of it. Saw it flagging out, saw the moving averages rising up. Lift, 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 lift. Beautiful trade. Cool. Still holding, gold holding from 177. Beautiful. All right. Yeah, you crushed it. So I was bullish from the same times as you, but I didn't hold as well, and I didn't hold as much leverage, it sounds like. So beautiful. I was in this trade from down here, but I sold so quick. I sold into 3K completely. It just kind of screamed on without me. I should have just got back in when it flagged here. So I've been underweight gold. I justified it by going heavyweight into silver. So that's definitely been my best trade of the year. Targeting 5K. I'm with you, brother. I'm with you, brother. I'm with you, brother. Let me go to my zoom out. We'll look at my old fibs that I haven't touched in months and months. Got to add more fibs. I don't know. Got to hit the 5K. I don't think we're done there either. On like a yearly chart, I think we're in a wave 3. So any Elliott wave guys out there, we have 5 wave impulse patterns that generally play out. So there's the 0 to 1, there's the 1 to 2, then you have the biggest wave, 2 to 3. Then you have 3 to 4, which is usually mostly a sideways correction. Then you have 1 impulse move up. So, few basic Elliott wave rules. The 1 to the 0 to the 1 is usually the same distance as the 4 to the 5. And we don't know how big this one is, but it will be the biggest. So maybe it does 6K-ish. Trade sideways to 5K, and then a move up to 7 something-ish. This is all very speculative, just spitballing here, but I wouldn't be surprised to see something like this. Everybody's so sure that this is going to be the top for like a decade, and I'm saying, go do your homework, go read some history books. This does not look like the start of a big sell-off in precious metals and risk-off assets that go up when geopolitical tensions go up and when commodities start moving up. So I'm very, very bullish. Very, very bullish. All right, guys. It's been 2.5 hours. I just realized I gotta call it here. I gotta call it here. If I didn't get to your stock, firstly, I apologize. Second off, don't worry, because next week we're going to be doing the same thing. And you can get my advice over the weekend too. Come on into my Twitter at Steve Teilman, SteveTeilmann. You can find my Discord right there in the bio. That's where you can reach me just about any time of the day or night. Unfortunately, I'm a bit of a workaholic. So that's where to find me. Find all of the great traders over at Trade the Pools Discord as well. We got some real hitters in there. Don't miss out. Long weekend. Let's call it, Black Mamba. I'm with you, baby. All right, guys. Let's get some rest. 3 days mandatory relaxation. You heard it from me first. Go take care of yourself. We're gonna rock and roll, but starting Tuesday, not Monday. So everybody have an awesome week. Hope you appreciated this. I do it for you guys, but I had a lot of fun too. So take care. We'll be back next time. Till then, enjoy yourself. Have a great weekend. Later.